everybody. Good morning. Good morning, dear guests. Good morning, dear colleagues. Yesterday, we had a truly great first day of the conference, and I discussed that with several of you during dinner, and I think you all share this sentiment. So the depth of the discussions have set really a high standard for what promised to be an equally stimulating second day. So building on the momentum we have established, it is a great honor to open this morning's session with the introduction of our keynote speaker, John Williams. John doesn't really need an introduction, but I have to follow my institutional duties. So allow me, nevertheless, to briefly highlight some of the key milestones in his remarkable career. John is without question one of the most influential figures in the field of monetary economics, and his contribution have profoundly shaped both academic research and the practice of policy implementation. John currently serves as President and Chief Executive Officer of the Federal Reserve Bank of New York. In this role, he is Vice Chair and permanent voting member of the FOMC. He has been shaping monetary policy in the United States for a long time. After his PhD in Stanford, his career began as an economist at the Board of Governors, and he has since served in several prestigious roles, including senior economist at the White House Council of Economic Advisors and President and CEO of the Federal Reserve Bank of San Francisco. John's research has been published in the field's most prestigious academic journals, including Quarterly Journal of Economics, the AER, and the JME. And if I may, and I was mentioning that today morning to John, I would like to share with you a brief personal anecdote that underscores my personal appreciation for John's work. Many years ago in the early 20s, when I was in a graduate school and I found myself poring over one of John's seminal papers on measuring the natural rate of interest. What a surprise. So while the paper itself was a masterclass, I have to admit, in clarity and precision, my attempts to replicate its results were anything but. I spent many long nights grappling with the math and the code. We talked about the Kalman filter, fueled by determination and perhaps a little too much coffee. So standing here today is therefore a great privilege for me. Your work, John, has inspired many of us here, and your insights have helped illuminate some of the most pressing challenges that policymakers face today. The title of John's address is Theory and Practice of Monetary Policy Implementation, a topic of great significance as central banks navigate an increasingly complex and uncertain environment. Following his address, we will have time for a Q&A session, which I'm sure will provide an excellent opportunity to further engagement. John, thank you for taking your time to join us. The floor is yours.
Thank you, Roland, for that a very nice introduction. I have to admit, one of the things I learned early on was the advantages of transparency when you write papers, especially very technical papers, in posting your code. Because we did definitely, you were not the only one who was working on replicating results, but also asking us questions about footnotes and things like that. So posting the code and the data was, I think, helped a lot. Which is now, of course, standard practice in economics. So good morning, everyone. It's wonderful to be here with you in Frankfurt in our very interconnected global economy. I've been coming to events around the ECB from before the ECB existed and looking forward to being here today. It's important to have these opportunities like this to learn from the perspectives and experiences of others, whether we're academics, market participants, or practitioners of central banking. So the theme of my talk is the theory and practice of monetary policy implementation. Importantly, central banks differ in their objectives, strategies, and approaches to monetary policy implementation, all of which influence how they supply reserves, manage their balance sheets, and control short-term interest rates. But like Neapolitan and New York-style pizzas, central banks also share similarities. These were spotlighted in the ways they responded to the global financial crisis and then the onset of the COVID-19 pandemic. Then many central banks expanded their balance sheets through various quantitative easing programs funded in large part by increases in central bank reserves. And these experiences fundamentally changed the ways that many central banks approach the provision of reserves while maintaining control of short-term interest rates. As a result, central banks have reviewed and in some cases modified their strategies for supplying reserves and controlling interest rates in ways that reflect the unique features of their jurisdictions. Although the approaches differ in specifics, they share common elements that reflect the fundamental factors that shape the supply and demand for reserves. So today, I'll talk about monetary policy implementation frameworks that central banks use to manage the supply and demand for reserves, emphasizing the common features and mechanisms of these approaches. I'll also discuss in more detail the Federal Reserve's ample reserves framework. Before I go any further, I have to give the standard Fed disclaimer, and that is the views I express are mine alone and do not necessarily reflect those of the Federal Open Market Committee or anybody else in the Federal Reserve System. Monetary policy implementation frameworks are critically important to the conduct of monetary policy. They encapsulate the mechanisms and tools used to steer operational targets in line with the desired policy stance and provide liquidity to the financial sector. In supplying reserves to the banking system, central banks have multiple goals that frequently involve trade-offs. First and foremost, they target a level of the policy rate and aim to minimize the variability of the policy rate around that target. In addition, they have objectives related to supporting financial stability and the smooth functioning of financial markets. For example, central banks may see advantages or disadvantages to interbank lending in money markets, as well as costs and benefits related to central bank lending into markets. The core of any operational framework is the central bank's supply of reserves, which ranges from a low level, or scarce, to ample and abundant. The price of reserves is the spread between the market interest rate and the rate earned for holding reserves at the central bank. When reserves are scarce, the slope of the demand curve for reserves is steep, as I've illustrated here in Figure 1. A small change in the quantity of reserves results in a meaningful change in the spread. When reserves are ample, the slope of the demand curve flattens, but still slopes downward. So the small changes in the quantity of reserves have modest effects on the spread. And when reserves are abundant, on the right side of the figure, the demand curve is essentially flat. A central bank has basically two sets of tools it can use to supply reserves. And now these are illustrated in Figure 2. First, it chooses the ex-ante aggregate level of reserves to supply to the banking system. And that's labeled X on the figure. Second, it may make available a lending facility, broadly defined, to the banking system that offers loans to financial institutions at an interest rate determined by the central bank. And this is labeled by L in the figure. So if the ex-ante supply of reserves is sufficiently low, to the left side of this figure, the additional demand at rate L will be met by the lending facility. Note that both tools are a means to supply reserves. In the first, the supply is set in advance, while with the latter, it adjusts endogenously to market conditions. Now, central banks deploy various combinations of these tools depending on their institutional and market structures in their jurisdictions, as well as preferences over the trade-offs involved in their use. These choices represent, I would describe as different points among the set of options for using the two tools. So despite differences in the tactics, each of the approaches can achieve the goals of strong interest rate control and smooth market functioning. It's worth emphasizing that the two tools can be mutually reinforcing in achieving desired outcomes. For example, lending facilities limit upward movements in interest rates on days of high demand, thereby reducing the ex-ante supply of reserves needed to control short-term rates. The European Central Bank, the Bank of England, the Reserve Bank of Australia, they've all chosen to operate with a relatively small amount of ex-ante reserve supply and provide additional reserves as demanded at a rate near the policy rate. Counterparties can then draw upon as much or little as they choose based on their needs, subject to the ability to provide eligible collateral. In this way, even with a smaller ex-ante supply of reserves, tight interest rate control is maintained amid even significant movements in the demand for reserves. In the case of the Bank of England, the weekly short-term repo facility sees regular sizable use. In October of this year, it averaged around £85 billion. Like that of other central banks, the Fed's operational framework has evolved over time, reflecting its experience with large balance sheets since the global financial crisis. In January 2019, when the decline in the Fed's asset holdings implied that the quantity of reserves would soon fall below an abundant level, the FOMC formally adopted an ample reserves strategy. The FOMC has defined this framework as one in which control over the level of the federal funds rate and other short-term rates is exercised primarily through the setting of the Federal Reserve's administered rates, and in which active management of the supply of reserves is not required. Accordingly, the ex-ante supply of reserves is chosen to be sufficiently large to meet the demand for reserves on most days. One important tool the FOMC has established to ensure interest rate control is the overnight reverse repo facility, the ONRP, which alongside with the interest paid on reserve balances helps set a floor for the federal funds rate. Through the ONRP, eligible counterparties lend to the Federal Reserve at the rate set by the FOMC, currently at the bottom of the target range for the federal funds rate. And the usage of the ONRP adjusts automatically to market conditions, rising and falling with supply and demand, which is particularly important in a dynamic market such as ours. The ONRP has proven to be a very effective and a flexible tool to support interest rate control to the downside. When Federal Reserve asset holdings push reserves above ample, the ONRP relaxes the tight relationship between balance sheet size and reserves and acts as a safety valve in supporting smooth transmission of monetary policy to markets. As the size of the balance sheet falls, market rates rise above the rate offered at the ONRP, and as a result, usage of the ONRP declines to lower levels. This dynamic is seen in Figure 3, which shows average monthly usage of the ONRP from 2016 through October of this year. And this figure, the 2000, that's $2 trillion. So ONRP had very significant usage. The ONRP was used extensively when it was economically sensible for the Fed's counterparties to do so. By contrast, it has seen very limited usage when repo rates are well above the ONRP rate, as is the case today. Back in 2021, the Federal Reserve introduced a standing repo facility of the SRF, which nicely complements the ONRP by providing interest rate control to the upside. The SRF rate is set at the top of the FOMC's target range for the federal funds rate, and this combination of an ample supply of reserves and an SRF rate at the top of the target range reduces the day-to-day reliance on the facility, except during periods of significant upward pressures on rates resulting from strong liquidity demand or market stress. By ensuring that adequate liquidity will be available in a wide variety of circumstances, the SRF plays a critical role in capping temporary upward pressure on rates and ensures markets of effective interest rate control and smooth market functioning. It's best thought of as a way of making sure that the overall market has adequate liquidity consistent with the FOMC's desired level of rates. In that regard, it differs from other lending facilities, such as the discount window, that aim to provide individual banks with liquidity when the need arises. The SRF has been effective as reserves have moved from abundant toward ample. Over the past 2 months, SRF usage has risen from essentially zero to having greater frequency and higher volume of take-up, especially on days of temporary repo market pressures, as seen in Figure 4. And in this figure, for those who can't see, the label of the access goes up to $60 billion, and the chart goes back to July of 2024. And this includes the last a couple weeks through early this week. Like the ONRP facility, the SRF's effectiveness relies on market participants availing themselves of the SRF based on market conditions, free of worries about stigma or other impediments. And I fully expect that the SRF will continue to be actively used in this way and contain upward pressures on money market rates. At the outset of the pandemic, the Fed, along with other central banks around the world, responded quickly to restore market functioning, causing reserves to rise well above ample, as they did in many jurisdictions. In June of 2022, the Fed began the process of reducing the size of its balance sheet to transition toward an ample level of reserves. The FOMC said it intended to stop balance sheet runoff when it deemed that reserves were somewhat above ample, and then allow reserves to decline further as other liabilities, such as currency, grow. The process has worked according to plan. The Fed's securities holdings have shrunk from a peak of around $8.5 trillion in 2022 to $6.25 trillion today. At its meeting last week, the FOMC decided it would conclude the reduction of its aggregate security holdings on December 1st. This decision was based on a clear market-based signs that we had met the test of reserves being somewhat above ample. In particular, repo rates have increased relative to administered rates and have exhibited more volatility on certain days. Accordingly, we have been seeing more frequent use of the SRF. And the effective federal funds rate has increased somewhat relative to the interest on reserves after years of that spread being at a very stable level. Together, these developments were expected as the supply of reserves closed in on ample. Looking forward, the next step in our balance sheet strategy will be to assess when the level of reserves has reached ample. It will then be time to begin the process of gradual purchases of assets that will maintain an ample level of reserves as the Fed's other liabilities grow and underlying demand for reserves increases over time. Such reserve management purchases will represent the natural next stage of the implementation of the FOMC's ample reserve strategy and in no way represents a change in the underlying stance of monetary policy. Determining when we are at ample reserves is an inexact science. I am closely monitoring a variety of market indicators related to the Fed funds market, the repo market, and payments to help assess the state of reserve demand conditions. Based on recent sustained repo market pressures and other growing signs of reserves moving from abundant to ample, I expect that it will not be long before we reach ample reserves. The FOMC's implementation framework combines an ample supply of reserves with facilities to maintain strong interest rate control and flexibility regarding changes in the size of the balance sheet. This operational framework has proven to be highly effective, and it continues to work as designed. Now, other central banks use different approaches that operate equally well. We all face common goals and issues, and like the delicious delicacies particular to all of our individual countries, the similarities outweigh the differences. Thank you, and I look forward to our conversation. They tell us where to sit, Roland.
Good. Thank you, John, for an excellent and insightful speech. I must say I followed and appreciated all your arguments, though having lived in Italy for 4 years, I might take an issue with your claim that there are similarities between pizza napolitana and New York style pizzas.
You know, this was the riskiest thing I said in my speech. I have a lot of my friends and colleagues at the New York Fed have very strong views on Italian pizza. I took a chance, and obviously it's backfired already.
Okay, but on a more serious note, your framework that you described, and I think you talked about that also earlier in your May speech, and also you have research papers about the optimal supply of reserves, is really incredibly valuable, and it provides a clear and structured way to analyze the similarities between various operational frameworks. And of course, we also very much appreciate your statement about the way forward concerning balance sheet normalization process. So linking up with maybe the two parts of the speech, and you alluded to that, you described that after terminating quantitative tightening, or let's call it quantitative normalization, Isabel, right? We had a story yesterday with Isabel's speech who introduced a new terminology, quantitative normalization.
Well, okay, so I have to speak to that. My experience of the Federal Reserve is we've desperately tried to convince the world not to call things quantitative easing, quantitative tightening. We have large-scale asset purchases, normalization. It never works. The markets will come to their own decision, and they'll use whatever terminology, and then in the end, we end up taking it on.
So we know what we are talking about, okay? So the next step in the Fed's balance sheet management strategy, that's what you said, will be to assess when the level of reserves has reached ample, and this will be the time when the Fed will gradually begin the so-called reserve management purchases to maintain an ample level of reserves, as the other liabilities of the Fed will continue to grow, right? So at the same time, I think you showed it in your charts, we have observed more frequent use of the standing repo facility. So going forward, and we had a bit of discussion yesterday about the sequencing of the instruments. So going forward, based on your framework that you presented, how do you see the interaction between reserve management purchases and the use of the standing repo facility?
Yeah, and that's really a key question. I was trying to highlight that these tools are really both important, both the ex-ante supply of reserves as well as the SRF in this case, when we're thinking about the ample reserves working really well. And they are mutually complementary too. So you're absolutely right. So let me just say one thing I want to say slightly differently than the way you asked. I think when we think about reserve management purchases, it's not only to offset the decline in reserves that would happen through, say, the growth of our other liabilities like currency. It's also that we've learned through experience that the demand for reserves in the banking system grows with the size of the banking system, whether bank assets or other indicators. So we have to understand that this is a market where the demand for reserves is likely growing organically over time, but also can be growing in ways that are harder to predict in terms of changes in, say, regulation or changes in market structure. So it's not simply a mechanical kind of a response to that. But going back to your question, I think really it's about assessing, are we roughly in the ample reserves, kind of space, and does it seem about where we want to be? And then having purchases adequate, the reserve management purchases adequate to both offset the declines that would happen in our reserves through the growth of currency and other liabilities, and also we think is consistent with kind of the underlying organic growth of the demand for reserves. So that's going to be an assessment based on, like I said, the market conditions. We're seeing all the indicators that that we've been following. We published this about a whole set of market indicators that we're looking at, and also outreach we do with market participants and understanding that. In terms of where this question of how often the SRF is used and what quantity, I think this is also a learning experience. What we know in the repo market is there are certain days, pretty predictable days, where we see upward pressure on repo rates, end of month, end of quarter, tax payment dates, Treasury settlement dates. We've also learned that the end of the Canadian year is an important date that we can add to that list. And so we understand that there's going to be those kind of days. And so on days like that, you would expect upward pressure and maybe enough upward pressure that there'd be some SRF usage. We've seen that over the last, not just over the last couple of weeks, but actually going back a few months. So I think that kind of usage would be the normal kind of usage you have on days that there's some upward pressure, or of course if there's some unanticipated kind of shock to the demand supply, to the market, that the SRF is always there. So I see it as really playing this important role. I think two important roles. One is on these days that have what I would describe as idiosyncratic or temporary factors driving upward pressure on rates, that it gets used, in modest to moderate levels. But it also ensures that for market participants, this is something we learned. I mean, we heard loud and clear that the SRF is there in the future. So I don't have to worry about what's my fund, for my funding needs at the end of next month or the end of this quarter. So I think it's going to be a balance. Zero usage of SRF was probably telling you're out in the abundant reserves. If SRF usage was happening in meaningful amounts on days where nothing else is going on, that would tell us that we probably don't have as ample reserves as we're looking for. But like I said, it's an inexact science. I do think that we are definitely on the repo market side seeing indications of moving from abundant to ample. Some of the other indicators haven't moved as much, but it's really about a judgment. And I think that going forward, the issue is keeping, it's like a lot of things we do in policymaking, is trying to balance these objectives and do it in a I would say a predictable, consistent way.
Thank you very much. So just staying in the same framework, in one of your recent papers, you also discussed the concept of optimal reserve supply and the role of uncertainty and also shifts in the curve, right? I mean, you were discussing today more the movements along the demand curve, but there might be, due to financial innovation, change in preferences, there might be also shifts in the demand curve that creates a bit uncertainty about the path ahead. So how do you see, can you elaborate, how do you factor in the, in the assessment of the appropriate level of reserves?
Right, and I think this is a really important issue, and something that, yes, we did study, both empirically we see the evidence of shifts in the demand curve for reserves, but also, thinking about conceptually, and all policymaking is policymaking under uncertainty. So what your model tells you that if you had perfect information, what would you do, is a nice starting point, but you really have to layer on the various types of uncertainty. So I think when I think about this particular market, I think you can think of two types of uncertainty that we have to think about. One is relatively higher frequency or shorter term uncertainty. And the classic example for the Fed is the United States government has an account with the Fed, the TGA, Treasury General account, and that moves up and down for various reasons as the U.S. Treasury pays its bills and collects revenues. That's a perfectly normal thing, but that can move around. Well, when it is one of our liabilities, so when the TGA goes up, reserves go down, this is arithmetic. And so that's kind of a shorter term kind of a factor that can move around in uncertain ways. And if you think about in our model framework, it tells you, well, either on those days where the TGA, let's see if I can do my math right, goes up and reserves go down, that either you're going to see more usage of, potential usage of the SRF because upward pressures on repo, or you hold a little bit more ex-ante reserves. I think the right answer is you have both of these tools and you try to balance using both of the tools. And that's what our paper really looks at in kind of a theoretical way. Then there's a longer term uncertainty. So let me give you this. If you look back at where reserve demand was in 2019, when we were kind of going through the similar kind of process, I mean, it was significantly lower than it is today. And I think the number of factors have shifted the curve outward. You can think of regulatory changes going back since the financial crisis. You can think of shifts in the business models of the banks and institutions who want to hold more reserves or see advantages of that. So I think we've seen, you could think of more structural shifts. And those are hard to predict and hard to know when they're happening and the magnitude of that. So I think you always have to be kind of cognizant and learning about how maybe more longer term structural shifts. I think that one of the big question marks for all of us is, this is not about today or next few months, but how will potential regulatory changes in U.S. banking affect the demand for reserves? How will the growth of stable coins or other digital assets, how could that potentially affect these demands? So I think that the point I'm making is not that I know the answer, but that we have to be aware that structural changes in these markets or market structure are going to have effects on the demand for reserves. And our ample reserves means we do, like we do with monetary policy, we have to move the policy instruments consistent with the structural changes of the economy. We have to make sure that what we're doing is consistent with achieving our goals.
Thank you. I think it's always good if economists are humble. Indeed.
Good and sometimes rare.
So now shifting the focus, and then I open the floor for questions, but shifting the focus from the size of the balance sheet to its composition. Isabel's speech yesterday underscored the challenges central banks face in determining the appropriate composition of the balance sheet. So what do you see as the key factors to consider when deciding on the optimal composition, particularly with regard to the duration of the assets held?
Yeah. So first, remember I gave you the disclaimer at the beginning? So I'll repeat the disclaimer. I'm going to give my own views and not necessarily this is the Federal Open Market Committee. Obviously, the FOMC has made pronouncements about kind of how we think about this in some ways, but others still these are topics that we're always thinking about and will continue to think about going forward. The one thing that's unique, or not unique, but is specific to the Federal Reserve's balance sheet, and I know this isn't the question you asked, but I want to make this point, is that we hold not only U.S. Treasury securities, but we hold agency securities too, agency debt, but much more importantly, agency mortgage-backed securities. And the FOMC has consistently made the point that as we've gotten out of QE, that we want to have our balance sheet primarily, or securities holdings, primarily in Treasury securities. So moving away from MBS over time. So that's just first thing, just to make sure I say that, because that is a very important part. I think in terms of the optimal composition of a central bank's balance sheet, I think I'll go back to some of the principles I laid out about monetary policy implementation. First of all, I think there are some general ideas or principles that apply to a lot of jurisdictions, but some things are very specific to different jurisdictions, different kind of trade-offs that people are facing. I think for the Federal Reserve, because of the policy actions we took in response to the financial crisis and then QE1, see, I guess I gave up on this QE, so what I'm going to say to you, QE1, QE2, QE3, QE infinity, and then the actions in response to the COVID-19 pandemic and everything after that. We have seen our balance sheet, our Treasury holdings, it has much longer maturity on average than the Treasury outstanding. And I think that from my perspective, that's a response, that's because of the policy actions we've been taking. Over the last several years, we've been buying across the curve. And I think having a somewhat neutral or close to neutral maturity structure in a central bank balance sheet relative to what's out there in the market, it seems to make sense. Now, can I argue, is this optimal? Can I make a case that you should choose to have overweight this or underweight this or that? I think that we're basically in the world of keeping it relatively simple, keeping it relatively neutral. Obviously, in the United States, the U.S. government makes the decisions on debt management, the issuance of debt, and all of that. So they're deciding for the public where do they want what's the maturity structure of the debt for the goals that they have. I view a neutral stance of the Fed over the long run as being one that is consistent and supportive of that goal of the long run. Of course, in the short run, you have to have that flexibility in your balance sheet to be able to take policy actions that are necessary. But again, a neutral kind of composition, I think, supports that. So that's kind of the principles I think about. We have to, obviously, there's a question of, we're pretty long right now, very long in duration right now. There's always a question of how do you get there? But I think that's how I think about relatively simple, kind of neutral or consistent with what the outstanding that the U.S. government is deciding on.
Okay, thank you very much. So let's open the floor to the audience. Isabel?
So thank you very much, John, for a fantastic speech. I listened very carefully, and I believe I heard that you were actually quite open to banks using the SRF when they need it.
Yes.
So, if I'm not mistaken, that's a bit of a shift in tone, in the sense that there was a time when people said this is a backstop, which is really not supposed to be used, really only in very exceptional circumstances. So if there is this shift, I mean, it seems that actually your framework is moving a bit closer also in the direction of what we have in this more like demand-driven framework. And my question would be whether you would agree to that. Second, and relatedly, I mean...
that was your question, Isabel. Do you agree?
There's no leading.
So relatedly, I mean, of course, not every bank has access to the standing repo facility. Yeah. There's always a question, how does the redistribution of reserves work? And there may be friction, so maybe the small regional bank doesn't get access to the liquidity it needs. And then you also mentioned the discount window. So would you also say that for the discount window that it's less of a kind of backstop facility, and that also there banks should be should be encouraged to use it when they need it?
Well, okay, so there's a lot in that. When you said, are we moving closer to the ECB's approach, I actually think our approaches are just different points on the continuum, and I don't see them as far apart as sometimes maybe we talk about them, because we tend to talk about the technical parts. Conceptually, I think we're trying to achieve the similar things, and we're just different places on that continuum, and that's a point I made in the speech. I don't see this as a shift, so I want to be very clear on this. We did use the term backstop, and I have learned the hard way, and I really do not use sports metaphors in monetary policy. They always come back to haunt you. Backstop, at least in U.S. usage, has this sports kind of thing. If something that's behind you, it only catches the ball, if it goes past you. The way if you look at the FOMC's actual communication, which did use the backstop terminology, it's true. But what we said was to support interest rate control and to support smooth market functioning. And I completely agree with that. That has not changed. I think my view on the SRF is you think about periods where there's temporary increases or upward pressures on repo that is providing this cap or ceiling, or however you want to think about it, in terms of the upward pressure on repo. So should it be used, if it were used every day, would that be consistent with our framework? I would say no. If it's used on particular days because of particular circumstances, I think it meets this kind of test. Again, I think the term backstop maybe has and you used it yourself, as kind of this maybe unusual or something. This I view, and this is again, I'm expressing my view and the decisions we made at the FOMC. The SRF was never intended to be a crisis or a market, only a market stress thing. It was always meant to be interest rate control. If you go back to September 2019, which I kind of don't like to do, but I will, that wasn't a crisis. That wasn't a situation where financial markets were somehow in distress. It was a situation where there was, in fact, inadequate reserves in the system to have the interest rate control that we wanted. We didn't have the SRF at the time, so repo rates spiked significantly, and that did spill over into the Fed funds rate temporarily, and of course we mitigated that through repo operations then. So to my mind, this isn't about truly unusual or stressed or crisis situations. It's really primarily for interest rate control. I don't see that as a shift, but there's definitely an aspect of experience of that there are quite a number of days where you have these spikes, and I would say I'm not telling institutions what they should do. In my language in the speech, and I think the language we've been using is consistent. If it is there so that market participants, which is primary dealers and quite a few of the banks who operate in repo markets, that they're using this if it's economically advantageous or appropriate or sensible or convenient for them to do that. I do think of it, and you said this in the speech, and I think this is a subtle point. I see this as like when back in the day when we did repo operations to control the supply of reserves and interest rates. This is a way to provide market liquidity. It's not about an institution like the discount window who says, hey, I've got short-term funding needs, which could be for perfectly good reasons. I need this to kind of tide me over. This is really our way to make sure that there's liquidity. It's an endogenous supply of liquidity, and that is, I think, very similar to what's being done in other countries. So I don't see this as, again, a shift in this, but it's more of an application. In terms of the discount window, my view is the discount window has historically in the United States been stigmatized. That's very unfortunate because you want institutions using it when it's economically appropriate to do that. So I would love the discount window not to be stigmatized, and I really, it would be very unfortunate if the SRF were stigmatized. So to my mind, every institution should be using these facilities as appropriate.
So, Jacques?
And I would not, however, go so far as call our system demand-driven. That was for
At least not yet. Thanks, John, for your very interesting presentation. So I'm getting a sense that you're obviously getting more confident that you're getting close to ample reserves, and therefore a number of announcements you made. I'm curious to dig a little bit into your assessment. You mentioned market rates as a criteria for your assessment, and whether what has happened maybe happened somewhat faster than expected, or in fact there may be other factors which are influencing the market rates at the moment, away from just the shift in regime. You mentioned TGA, obviously, given the shutdown and the lack of less spending from Treasury and the rise in TGA. We also had a very interesting presentation yesterday from Shria, from the board, showing that there may be elements of segmentations within the interbank market, which in Europe we know very well has had impacts, disproportionate impacts on market rates. And so could there be also situations where parts of the system are starved for liquidity, and therefore the better policy response may be to have more targeted solutions for those parts of the system, as opposed to pushing liquidity overall that may still not find its way to the overall, to those institutions that are most in demand for liquidity?
So the two of you have really taken the multi-part question to new levels. See, and you shouldn't blame me. This is Europe. Yeah, you don't blame me if I don't remember all of it. On the first part of the repo market, so a couple comments on that. Yes, obviously a number of factors came together, especially in October and into early November. Some of it is the TGA having, the Treasury General account having increased somewhat more. Our interpretation is some of that, but it's not the biggest part, is the fact that government shutdown does mean less money going out and a little bit more cash on hand. But that is one of those stochastic factors that can happen. I know that right now that a lot of people are focused on TGA dynamics, and that's understandable. We also went through that with the debt ceiling issue, and those are important. But of course, I always take a step back and say, hey, there's uncertainty. A lot of different factors can change over time in the short run. TGA is just one of them, but other factors too. So our ample reserves has got to be able to operate effectively, even with whatever those shocks are, including things like movements in the TGA. So I think, and we had the whole bunch of things that are happening kind of at the same time around end of month, and the Canadian year end and all that. So there's just a number of factors. They're all accumulating, mostly in the same direction. So I think again, those things happen. They're going to happen. They can happen at different times. So we have to be aware of that. In terms of, so that explains why we saw a bit of a move up, and then now, of course, rates have moved back down. SRF usage is down to 0 or less. You can even see in my chart when it was up there. So there was temporary. I think this thing about, well, are we seeing it in the repo market but not seeing it elsewhere, and was it a little bit faster than expected? If you go back to 2018, go way back to 2018, in the first half of 2019, not late 2019, we were seeing some repo spikes at that time as well. So I think this is part of the, there's a transition period between abundant towards ample, kind of in that gray zone. Everyone talks about the kink, but you're going through that zone, and you start seeing the repo market having more volatility and upward pressure. We've clearly seen some upward pressure in the Fed funds level of the rate, not so much the volatility. So I think it's similar to what we saw before. What looks rapid is just because right now we just had some temporary spikes. What was the second part? Was yeah, so I think that is true. I think that has been true when you think about it. Getting back to Isabel's question, the SRF is basically, it can cover pretty much anyone who's carrying out repo operations, who's eligible, has eligible collateral. So I think there's pretty broad sign up for that. So I think that covers that. Of course, in the United States, I would say there's one huge difference between us and almost everybody, or maybe everybody, is we have this federal home loan bank system, which also can be effective at moving the redistribution, I guess was your question, Isabel, the distribution of liquidity across the system. And of course, for smaller banks too, they have the discount window. So I think we have ways that liquidity can be redistributed in the system. So your point is valid, but I think that in our system, it can happen through different dimensions, even if we're just providing liquidity at an aggregate level.
Thank you very much. Please.
Good morning. Thank you, John, for your really, really insightful speech. Eric Scotto-Dirina, the Rabobank. You did mention the importance to have a smooth market functioning and financial stability. And yesterday we did have some really good reviews of papers highlighting an increased role of hedge funds, for example. And therefore there is a noticeable change in microstructure. So I'm curious as to your views vis-à-vis the role of the Fed in this context and how it may change.
Yeah, that's another really great question and important question. And I think the facts speak for themselves. Unfortunately, was not here for that discussion, but I'm very aware of the role of this. And of course, the basis trade is something we talk about all the time. What happens in our capital, U.S. is a very capital markets intensive economy, financial system that what is happening out there is something we have to understand and understand what we're doing, how it connects. So when you think about financial stability there, I think it goes back to, you think about interest rate control and also making sure that we have adequate liquidity in response to shocks. And so when I go back to the pre-2019 days, I remember there was a discussion among academics and others in the central banking community, is the repo market should be the market that everyone has complete confidence in. Like, well, the fact that hedge funds are funding through that's their decision and things like that. But fundamentally, the repo market is, of course, the US Treasury repo market is something that we should have great confidence that it functions well, and of course the prices are occurring because of market forces, but it's functioning well. And so that's why I think in our monetary policy framework that we have with the ample reserves and with the SRF and the ONRP, all of those come together to provide very good interest rate control, but without us targeting a specific repo rate or trying to control it in a fine-tuning way, but allowing market forces to determine, supply and demand. Of course, as an economist, so it's only two words I know, but those affecting the repo rates, but making sure that kind of random or disruptive kind of movements in those markets don't create greater financial risks or vulnerabilities. So I think we're trying, again, I see it as kind of getting this middle ground. Markets are making market participants are making their decisions. We're providing, with our framework, stability in this key funding market, but the market forces are determining the rates. Of course, the Fed funds rates are our target.
Thank you.
We have a couple more.
Thank you. I'm Eliana Pietraro from Société Générale in Paris. I have a question regarding the standing repo facility. Well, we know that the market is huge. The take-up was still very modest compared to the market. Do you think that this modest take-up has to do with the fact that not all banks have access to it, or because the excess reserve is still very, very huge and banks use that to fund their operations? And what is the amount that you would view as posing a problem? Sorry. I had to ask it.
So I think that a couple things. One is on some of the days in that chart, because usage has been in single digits or maybe double digits, 10, 12 billion of SRF, which is in the repo market, which is multiple trillions of dollars. This is tiny. However, what we've seen, if you look at the auctions, we run 2 SRF auctions a day. What we see is that market participants see the tri-party rate, because we operate in the tri-party segment. If that starts hitting or getting near or is at or above the top of the range, which is, of course, the SRF rate, certain institutions will come in and they'll take advantage of that. Other institutions may say, it's a couple basis points, it's temporary. I've got other reasons. With my counterparties, I'll just keep those relationships going. So we're seeing economic forces and business decisions working exactly on the margin that we'd expect. Now, we did see a couple days where tri-party, was more than just a couple basis points above. But again, we saw more usage, and we, again, financial market participants are making trade-offs. If you think the repo rate's only going to be above the range by a few basis points for a couple days, this isn't a huge financial decision. But we are seeing on the margin this usage. And I think on most days, what it is doing is stopping that tri-party rate from going any meaningfully above the standing repo facility rate. So I think the modest usage represents mostly that we're in this transition from abundant to ample. Is there an optimal level or right level? I don't know what that is. I think my answer to Isabel covered. It's probably more on the frequency.
Leo?
Thanks. Indeed. First of all, thanks a lot for this super good talk that you gave. I found it very, very clear. I'm Leo van Tadden here from the Monetary Policy Wing in the ECB. I have a very simple question. When I listen to what you said from the perspective of the ECB, we are always, or I'm a little bit envious, because when you think about structuring outright a portfolio, buying, you can buy, at least until recently, US Treasury, which are perceived to be a super safe, risk-free asset, anchoring the entire global system. And you indicated, in fact, a slight preference going down with agency debt, and if it all concentrate even more strongly in US Treasuries. In Europe, the situation is different. We don't have this. We face 20 sovereigns, so not all of them entirely risk-free. This is already a slight difference. So my question is, to keep it very simple, and going forward, what's going to happen in the US? I don't know. How important is for the implementation, all the things that you described so well, the fiscal framework that operates, so to speak, in the background? In particular, when it comes to the decision how to structure the composition of a central bank balance sheet.
Well, I agree with your points. I'm not going to comment. I'm glad you didn't ask me to comment about ECB policy, and I wouldn't have done it anyway. But you're right. Our job is simpler. We have a massive, incredibly liquid, incredibly deep U.S. Treasury market, so that's where we operate, mostly, and that's where we're focused. So that is a huge advantage. It's also a critically important market for the global economy, as we've seen. When the U.S. Treasury market is disrupted in any way, that spills over to all of our markets and global markets. In terms of how I think about this, I do, this is a subtle kind of answer, I think, but there's the U.S. government, the U.S. Treasury has clear authority on the issuance and management of the U.S. government debt. We are the central bank and independent and able to make our own decisions about how we want to manage our balance sheet and holdings. These are separate, kind of authorities and separate responsibilities. When I think about how the decisions made by the U.S. government and specifically the U.S. Treasury on this, they have their objectives, which very clearly articulated, and I think they follow very consistently over time. And from a monetary policy point of view, we are not in any way trying to interfere or somehow offset or anything like that. We're just doing what we need to do monetary policy. So when we do QE or something like that, we are expanding or extending the duration of our holdings for a monetary policy reason. When it gets to, if they make decisions about changing the maturity composition of the debt, obviously that would kind of play into my earlier statement that in the longer term, I would think that we should have a debt composition that our treasury holdings that is neutral relative to the outstanding over longer periods of time. But that's not like a short run thing. That's about what does kind of the steady state look like in the composition. So I view these as two different kind of jobs that they have and we have, but they're the ones really making the decision about the debt outstanding and what with the composition of that. We're just holders we're just one of the holders of that debt.
Let's take one more question.
Okay.
Yeah, thank you for this very interesting conversation. Christoph Rieger from Commerzbank. Now, the origin of the latest tensions, I think, have clearly been in the repo markets, and I think we're seeing similar things in the UK. I would even argue in Europe to some extent, at least until this summer. Now, wouldn't you say that, given that there's more collateral still to come that the market needs to digest, and a lot of it doesn't end up with real money but needs to be funded in the repo market, so that this issue, I think, will grow bigger, and then that the SRF should really be the instrument of choice to really address this and could potentially also grow structurally over time as the balance sheet normalizes from the Fed?
Well, I agree with the premise that obviously the amount of U.S. government debt is growing, not shrinking, and is likely to continue to do that. The markets need to finance that debt will continue to grow. And I don't know if anyone showed the picture of the size of the repo market in the United States. It has grown dramatically over past recent decades or recent decade. So I think those facts are all right. I think the question of going back to, we have this decision, we have this ex-ante supply of reserves, which is really getting back to the amount of securities we hold on the asset side of our balance sheet, versus this issue of how much the SRF plays the role. I think that I'm an economist, so I have to use this term. The right answer is an interior solution. It's going to be a combination of both. It's not going to be the SRF is never used, but it's in our ample reserves framework. It's not that the SRF is the marginal supplier of liquidity on a regular basis. And I know Vicky's here, there you are. But I mean, I think the Bank of England represents a very clean example of being in the market on a regular basis, which works really well. So that's not our framework, and we're a little bit different from that in terms of where we are in this continuum. So you said the SRF will play a really important role. I agree, but I don't see it as the important role in the sense of we're going to have increased amounts of our provision of reserves through the SRF. I think we got to get this value X in my chart, right, that we have enough ample reserves. So the SRF is really playing this role of being the endogenous, but if you will, I said safety valve, I guess, in my remarks. It's the flexible part that can adjust to market conditions of a more temporary nature, not a more structural or permanent nature.
So John, this has been really great. So let me conclude this session with only one sentence. What a great start of the day. Thank you very much.
Thank you, Roland. That's great. Thank you.
So there will be some changes in the seating arrangements.
So good morning, everybody. Once again, we're now starting the fourth session with academic papers. And before we start, I'd just like to thank the organizers for making this great choice of papers. We have had lively discussions, and I hope very much that we will have lively discussions in this session as well. So the topic of this fourth academic session is non-banks. The first paper will be presented by Franklin Allen. It's Monetary Innovation and Financial Architecture, which is co-authored with Ansgar Walter and Franklin. We're looking forward.
Thank you. So I'd like to thank the organizers for inviting me. I used to spend a lot of time in Frankfurt, but I haven't been here for some time, and it's very nice to be back again. So today there are over 24,000 cryptocurrencies. Many of them are not in active use, but quite a few still are. It's difficult to measure exactly how much they're worth, but my colleagues in computer science tell me it's about $4 trillion worth. So just to give you a rough idea of the equivalence of that, it's like having the auto industry. It's the same amount of wealth that it's created. Bitcoin is obviously the most famous. I checked it yesterday. It was trading at just over $100,000. That's down from the max, which is around $125,000, but obviously it's still very valuable. It was originally designed as a means of payment, but because of its volatility, it didn't serve that purpose very well. Now, when the proposed Libra was designed and talked about as being a way of having a stable coin where you could have the advantages of Bitcoin, in other words, quick execution and things like that, there was a lot of interest in that. And there were early problems with ones which were actually implemented, and a number blew up. And I think it's important to remember that probably a zero interest time was not a good time to try stable coins, because people took risks because that was the only way they could make money from it. And so today, because you can't pay interest on stable coins, they're a money machine. You can invest it on treasuries and get large return. And now, today, Tether is over $100 billion of transactions a day. So it's small relative to the total, but significant. Now, initially, central banks were very skeptical about the role of crypto. But as the world evolved, it's become more and more attractive, and many countries are now seriously considering CBDCs. There are three that have them actually in full operation. So the first was the Bahamas with the sand dollars, the second was Jamaica, and the third is Nigeria. Now, having said that, I think the country which probably has the most advanced in some way is China with the yuan. So the original idea was that for the 2022 Beijing Olympics, they'd have a fully active CBDC. It didn't work out that way because of COVID, so they had the pilots, they did those things and went through with that stage. And in some sense it is in operation domestically. I think today that the biggest important role of the yuan is cross-border. Domestically, it's very difficult for them to compete with Alipay and WeChat Pay. Those are such efficient domestic payment systems that the yuan doesn't compete. But now with the mBridge initiative, the yuan is beginning to be used for oil transactions with the Middle East. And if we do have an increase in political tensions, I'm sure they're ready to scale up and start using it in large quantities. Now, this is an area where the US is going in a different direction than Europe and the rest of the world. So Trump, one of the first things he did was to ban the research of CBDCs among in the Federal Reserve System, as I understand it, and in the Treasury, and in other government agencies. So last week, of course, the ECB announced that they're going to have a pilot of the euro starting in 2027, and then the notion is that there'll be full implementation by 2029. Now, so what we are interested in this paper is, first of all, we've got these significant changes in the way that money works. We've got this public innovation of CBDCs. It competes with bank deposits potentially, and you can think about this as having retail deposit at the central bank as being the extreme form of it. And then in private innovations, we've got stable coins and various other payment mechanisms, which are in different parts of the world increasingly efficient. Now, at the same time as that, we've got a significant change in the financial architecture. So it used to be that the classic example of a non-bank was GE Credit. GE Credit had the feature that instead of raising money with deposits, it raised it in capital markets. And that meant it was a non-bank, but otherwise it lent money very much like other banks. So GE Capital was a very important forerunner. But with the breakup of GE, it doesn't exist in the form it used to. Nevertheless, non-banks have continued to increase their importance, and at least by some measures, they now constitute about half or more of lending in the US. There are large differences in the stability of, in the leverage and stability between banks and non-banks. So non-banks don't use as much debt. They have much larger equity. And their debt is much less concentrated. It's much more concentrated than deposits. Now, I think one of the important issues here is the fact that the banks have developed a strong lobbying effort in pretty much every country. And so they are subsidized to a degree that non-banks aren't. So they have bailouts, they have subsidized deposit insurance, and many other forms of subsidy. And so we're going to take that as given. You might just say to what I'm going to argue, the model I'm going to develop, well, why don't you just change it and get rid of all the advantages, the political advantages that banks have? And that Martin Hellwig can explain why that doesn't work very well. So what we're going to do is develop a model which takes account of this non-bank issue. And let me just run through very quickly this findings of Zhang et al. Of the non-bank system. So non-banks have substantially more equity capital, so lower leverage than banks, but less than non-financial firms. Leverage across non-banks is substantially more dispersed than leverage across banks. So banks tend to go to the limit, whereas non-banks seem to make a more structured, capital structured decision. Non-banks finance themselves primarily with short-term loans, and they originate long-term loans. So in many ways, they're very similar to banks. As I said, their debt is much more concentrated than banks' debts. Non-bank capitalization decreases substantially with size. So the bigger they get, the more one could interpret this as being that they're likely to be bailed out. That they may not have a formal guarantee, but if things go wrong and you're a very large lender, then the market seems to think that the government may well come and bail you out. And consistent with our average interest rates on uninsured debt decline with size for banks and non-banks. And non-banks pay substantially higher rates than banks on debt. So what we're going to do is to develop a model of these kinds of things. So this is going to be a model with a number of margins. We're going to have banks that choose their capital structure, and similarly for non-banks. Both of them are going to compete in a market for investments, or in other words, for loans. And what we're going to have is them making decisions and deciding things endogenously. So it's quite a complicated model. I'm not going to go through all the details, but I'm hoping I'm going to give you some of the basic machinery that you'll need to understand some of the results that we're going to look at. And the basic question we're going to look at is what's the difference between private money creation, so stablecoin kinds of things, and CBDCs or public money creation. So I'm going to use B for banks and N for non-banks. They're going to issue debt to households, and they're going to compete for these risky investments or loans effectively. Later, we can relax that. Households fund the banks and non-banks only with debt investments. So we're not going to have an equity market explicitly there. What we're going to assume is that the intermediaries or the people that own the intermediaries can provide the equity capital that they need. Now, we're going to assume that banks have various advantages, one of which is that they may be bailed out, so that you know if you're going to invest in a bank, it's not going to default, that it's going to be bailed out. We're going to have various types of monetary services. So this is going to be very much in line with the convenience yield view of the world, which has come back in recent years. So the Krishnamurti and Jorgensen's kind of view of the world. So we're going to take money as being something in the utility function. So utility of the household, the equation at the bottom is going to be your consumption today, and there's only one date up in the future, and that's going to be your expected consumption. So everybody's risk neutral here. We don't have any risk aversion. And then there's this third term, which is your money in the utility function. And the M bar is the aggregate monetary services that are provided by the various types of payment systems you have. So you can think of this as being, you have a bank account, and there are a number of ways you can make payments. You can do it directly with a debit card, or you can write in the US checks, or you can have a credit card and you can pay that monthly and so on. These all have different amounts of convenience, and this is represented by the thetas in the equation. So theta B times MB that's what banks give you. Theta B is this quality that they provide of monetary service. MB is the quantity. Theta N is the non-banks. MN is the quantity of that. And then theta C and MC are the base money that is provided by the central bank. The theta B is greater than theta N, so banks have these advantages compared to non-banks. So the novelty of this, as I indicated, is we've got endogenous leverage, we've got endogenous relative sizes of banks and non-banks, we've got public and private money supply, and the formal details are in the paper. So the first thing is that the intermediaries, so the banks and the non-banks, choose their capital structure to trade off in the usual sort of corporate finance way. So we've got cost of equity issue and distress costs and so on. And then they take into account if they're banks, bailouts, and other things, and so on. So what you can see is that if you're a bank, so we start with the blue line, and you have high convenience yield, so your money that you're effectively creating is very convenient, then you can charge a lot for that, and the bank is worth a significant amount. And because you have this ability for your debt to be good and have a high yield, you have a lot of it, so they have a larger size. If you have less convenience yield, so this is the red line, you have less debt, but you're still valuable. If you're a non-bank, you don't have such good opportunities, and so it's the black line, and you end up being less valuable and having lower value, lower debt. So if we think about what's the equilibrium look like in the money markets, what you can show is that there's an upward sloping supply curve, that's the red curve, and a downward sloping demand curve. Okay, so the vertical line is lambda, which is the monetary premium, and the horizontal is the amount of money that's out there. And ultimately what happens in this model is that the public supply of money, the theta C MC, determines the equilibrium money premium. So if we have a public monetary innovation, so something like a CBDC, then effectively what happens is that we have a move to the right of the money supply curve, and it moves down the money demand curve, so we have lower money premium, and in some sense the monetary system is working more efficiently. So there are a number of positive effects of that in terms of you have lower distress possibilities and so on, because what's happening is that their banks are using less debt and are shrinking relative to non-banks. So we've got this endogenous financial architecture structure. Private monetary innovation, as we'll see, is somewhat more complicated in that it can go both ways. You can get a similar effect as we just saw with the public money creation, but it can also go the other way, and we'll talk about this more in a minute when we look at an example. And so initially you can have an increase in the monetary premium and the welfare effects going in the opposite direction. So in terms of welfare effects, if we increase the monetary effectiveness of these payment systems and so forth, there are two effects on welfare. So the first is the Friedman effect. So generally, if you increase the amount of money, it makes people better off because they have more liquidity and so on. And that's what happens here too. There's also a bailout effect, because if you have more money and so on, welfare increases if banks leverage or market shares decrease. Now, I'm going to not go through the example in detail, but let me just say that this is a rough numerical illustration, and it's roughly calibrated to the US. Now, what we've got here is the effect of some public monetary innovations. And let me just explain what's going on here. So what we've done here is, if you've got, look on the horizontal axis, we've got the lambda, which is the monetary services provided by the banks and the non-banks. Now, what happens is, in terms of lending, so loans and investment and so on, if you look at non-banks in the top left-hand corner, what you can see is that we calibrated, so at 1%, which is about the kind of number that Krishnamurti and Vissing-Jorgensen get for convenience yields, we've calibrated so that the non-banks are about 60%. If you take that down to zero, they go up to about 70%. Banks, which are the blue line, go from 40 to 30 in that period. So that's one of the big changes that's happening in this model as you do various innovations. And as I say, this is a public monetary innovation, so something like a CBDC. If you look at what happens to banks and non-banks' equity assets to equity ratio. So it's the inverse of the equity amount. So what you can see here is that the leverage ratio on the top right-hand corner of banks is about 9. So it's about an 11% equity ratio. As you increase that, you run down the lambda, the monetary services premium, then the leverage ratio goes down and the equity goes up. Here we've got non-banks as stationary with that. In terms of probability of distress, that's the bottom left-hand corner, what happens is that the banks have more equity as lambda goes down, and so their probability of distress goes down. If we look at the expected fiscal cost of the given bank distress, then you can see that goes down. As banks start having more equity, they default less and cost the public much less. Now, in terms of private monetary innovations, what you can see here is that if you start out with an initial bank share of about 40%, then the private monetary innovations are always good. They reduce the monetary premium, and that's the left-hand graph. The case where you get things going both ways is where you start with banks having the high share initially. So at 100%, as they have a private monetary innovation, so the theta n is going up. Initially, the total effective supply of money goes down, and you get an increase in the price of monetary service. So it goes up, and then eventually, once it gets roughly the same as bank, then we go down, and so we then go downwards to that. So private monetary innovations have different welfare effects than public ones. Public ones are always good, private ones can be less good. So what we have here is very much a general equilibrium model where we take account of the effective allocation of resources across the economy, with the financial sector playing a primary role. It's very simplified, obviously, but what that means is it's fairly tractable. What you can see is that the effects of monetary innovation, which seem to be so pervasive at the moment, are significant, and they're significant in two ways. They not only effectively change what's happening directly through money, but they also change the financial architecture in terms of changing the balance between banks and non-banks. I think one of the most important roles of the model is as guidance for empirical work. So if one takes these changes in the world that we see as being important, then we can't take the financial structure as fixed. We need to understand where we are in it. Does it make sense to have private innovations only? Does it make sense to have public innovations only, or do we want a mixture of the two? And for that, I think we need detailed empirical work, and this model provides at least one way of starting to think about that. So let me stop there. Thank you.
Super, then we go on to the discussion. Adrien Daverna. Thank you.
Thank you. Thank you very much to the organizer of this conference. It's a real privilege to be here and to be discussing a paper of Franklin Allen. All right, so there's an active research agenda on understanding the architecture of the financial system. This agenda generally focuses on understanding how regulation and central bank intervention can both maybe strengthen and potentially fragilize the system. This paper focuses on how monetary innovation impacts the financial system, The big trade-off that they're going to study is financial stability versus the provision of money-like assets, whether it is by regulated banks, the central bank, or unregulated non-banks. There's a very big, important result here that public monetary innovation always increase financial stability and welfare. Right, so before I start by giving my comment, I would like to put the paper a little bit into context and maybe argue along the way that what Franklin calls public monetary innovation is very much related to everything that we have discussed in this conference. So we have observed a lot of changes in the architecture of the financial system. You have seen this picture ad nauseum. We have much more reserve than we used to have. This has important consequences for liquidity market. The Fed funds market becomes mostly irrelevant as traditional banks becomes completely satiated with reserve. In a sense, this development of the central bank balance sheet has pushed liquidity tension outside of the interbank market and into the shadow banking sector. So this is the price of liquidity and money now in the current architecture of the financial system. What I'm plotting here is the repo IRR spread, so the interest rate on a three-party repo minus the interest on reserve. When you see this picture, the first question you should ask yourself is, why in a system completely flushed with liquidity, with more than 4 trillion, with much more reserve, why do we see so much fluctuation and movement in the price of that liquidity? So there's two important regulations that shapes how the system is nowadays. First, you have balance sheet cost, so leverage ratio regulation that curbs liquidity intermediation and allow the spread to be negative. Remember, when the spread is negative, what a bank could simply do is fund itself in the repo market and invest that in reserve and make an arbitrage. They cannot do this because balance sheet space is very costly for them, and so this intermediation is not economical, and this is what allows this spread to be negative at times. Now, you also see that these spreads tend to spike at some times and become positive. So again, this should be an arbitrage for traditional bank that could swap just its reserve to lend into repo market. And so another piece of important regulation in the current, that shapes the architecture of the current system is this intraday liquidity regulation that constrains very much the lending of traditional bank in repo. And so I would like to argue that maybe the repo market, where when the spread fluctuates between the two bonds here, and hedge fund and dealers then lend to money market funds and firms and ultimately household, is a form of non-bank monetary innovation where the non-bank system is providing a lot of that liquidity. Now, when the floor set by the central bank is binding, we have the reverse repo facility that becomes active. John had a much better picture, more up-to-date, where we see the uptick during the whole COVID crisis. And this could be thought, I think, in the lens of the model as a public monetary innovation, where the central bank is not directly providing liquidity to money market funds and ultimately households. All right, so now we have another consequence of the leverage ratio regulation where balance sheet space become very costly, is that treasuries are now not held by traditional bank, they're held by shadow banks in our system. The primes at hedge fund face much more fragile funding sources. They do not have access to deposit. In that space, when you observe a dash for cash, as for example, the COVID shock, these hedge funds are going to offload all of these treasuries. The yield on treasury spikes and treasury lose their safe asset status. And so in that sense, some non-bank monetary innovation, when non-bank are in charge of doing a lot of the liquidity, provision of liquidity, can amplify the fragility of the system itself. All right, so I hope that I convince you that given there's massive change in the architecture of the financial system, this is a very timely paper. As we see, the architecture is often evolving faster than our frameworks, and so we need a lot more framework thinking about these issues. The paper in a nutshell, you have banks and non-banks that both issue money-like liabilities what a trade-off cheap financing versus default risk. One first big result is that public monetary innovation always improves welfare. The mechanism is very simple. When the central bank provides liquidity directly to households, it competes with deposit, it lowers the convenience yields. So that means that banks that trade off credit risk versus the convenience yield of issuing cheap deposit needs to cut leverage to reduce default risk because the benefit of that intermediation is lower. The second result is that private monetary innovation has ambiguous effect. When there's services are provided by non-banks, you have an improvement on monetary services that will increase welfare, but you have important reallocation effect that might be negative and create an ambiguous effect in the end. The paper then does important welfare analysis, where they're going to trade off the Friedman rule, so how close we are to completely satiate the system with liquidity versus the probability of bailout and the increase in potential systemic risk in the system. Right, so my comment is mostly going to focus on the following. Franklin makes very important and strong normative claims about public and private monetary innovation. I would like to argue that it requires very strong credibility. In a sense, it must align with empirical evidence. I think it needs to also align with all the policy concerns and policy debates. And you cannot have first-order missing pieces if you want these normative claims to be taken seriously by policymakers. Now, I would like to highlight the only reason why I'm able to make this comment in the first place is because of how ambitious the paper question is in the first place. Okay, so I think if we take the framework very seriously, the first best in this system is that the central bank would provide all monetary services, and we would have no non-bank sector. And this is because in the current framework, there is no cost basically to an expanded central bank balance sheet. I think as we have seen yesterday during the discussion, the different keynotes, this is core to current policy debates. One way to address this is to pick one of the following, where you think that a large balance sheet crowds out a private market. You can think about the fiscal cost of a very large balance sheet and the threat that it causes to political independence when you have an important footprint on financial market. And so here I'm arguing that modeling the cost of central bank intervention is necessary in order to capture this first-order policy concern and directly address the question that we are asking ourselves about how to best design the financial architecture of the system. There's also, in the current framework, no endogenous reason for non-bank to exist in the first place. If you would allow households to decide whether they want to create a non-bank or create a bank, they would always decide to create a bank. And this is because, I mean, you have a small technicality that we can discuss later, but non-banks are worse at providing monetary services and do not benefit from government guarantees. Obviously, this is counterfactual. We see a strong rise of the non-bank sector, and this caveat risks to provide very mechanical benefit to decrease the non-bank sector in the current framework. And so here I would argue that we need an endogenous banking sector in the framework in order to capture these forces, these important forces that shape the architecture, the current architecture of the financial sector. Two other missing pieces. The authors assume that regulatory constraint always lack. So they have a short discussion about this, and they justify this with the work of Begono et al., the Q theory of banks, where in that paper they showed that the book measure really binds with the regulatory requirement. But I would argue that this is because banks have large buffer in order to make sense that the regulatory measure are never binding, right? In a sense, the regulatory constraint, so SLR, is so binding for banks that banks are going to do everything they can to never have even the chance of breaching this regulatory constraint. There's also a very large literature that documents the impact of binding regulation. I'm just citing here one working paper from the ECB, but there's many more. And so this is really important for the result and the mechanism of the paper, because leverage dynamics in the paper really drive a lot of the forces, drive the stability and the welfare terms, right? So if leverage constraint would always be binding, you have no change in credit risk or leverage for banks. In a sense, the policy prescription of the current framework is, if there was no binding regulatory constraint, you should then introduce a binding leverage regulation in order to reduce credit risk and systemic risk in the framework. Another piece that I think is missing is that currently non-banks are considered to be non-systemic in the sense that they would never benefit from potential bailouts. I think that we would not have this conference if we didn't thought that non-banks liquidity provision was non-systemic. 2008 could be seen as a run on prime money market funds. You have obviously the treasury repo market risk versus via backstop, but maybe that's not the word I should use. Okay. Now, here's my vision of maybe the next version of the framework. I would have equity being expensive and an explicit asset that household can invest in. Not only intermediaries, wealth could invest in equity. It is very expensive because it does not benefit for the convenience yield. So a bank finds the leverage ratio very costly because it has access of another cheap financing sources. And when it's forced to issue equity, it needs to pay a much higher interest rate. In that framework where equity is very expensive because it does not benefit from the convenience yield, the leverage ratio regulation would always be binding. And one consequence is that an over-tight regulation in that context can choke liquidity creation. I would have non-banks to be systemic, and so maybe benefit from bailout in expectation. And that the reason that they exist is because regulation is always binding for banks, and so non-banks benefit from regulatory arbitrage. Now the downside of non-banks is that they are less safe and maybe provide much less convenience debt. In that setup, tighter rule would actually drive and shape the architecture of the financial sector and incentivize more fragile non-bank intermediation because of that regulatory arbitrage. And so finally, maybe I would shift the focus away from credit risk, just because when we talk about money, generally we have in mind financial liabilities that are not prone to credit risk, right? Can you really have significantly risky debt be a liquid asset? In a sense, stablecoin issuers are fully collateralized, the ones that are not already collapsed and not there to be here. And the largest non-bank market for liquidity is the treasury repo market, which is secured. And so the question I have maybe for Franklin is, in that different setting, I'm very curious to know then what is the impact of public versus private monetary innovation with binding regulation and collateral. And I could not answer the question myself, so it shows that maybe there is a reason for writing that paper. I would also argue that if you want to make very strong normative statement, the quantification of the different forces in your model become extremely important. And so I would encourage you to be very serious about the calibration and the estimation exercise. And I think that you actually have a lot of moments that have been uncovered in the literature that you can use. What I envision is basically a model that would be able to account for the change in the architecture of the financial system that we have seen over the last 15 years as a proof of concept that the model is able to take into account the key forces that shape the architecture, and can then make prediction about what would happen with monetary innovations. So matching this moment could very much quantify the model's underlying force and help you increase the credibility of the framework. All right, so in conclusion, I really enjoy reading and thinking about the paper. I think it's very timely. It's a very ambitious paper that is very much needed to think carefully about the theory of a very fast evolving system in order to make it policy relevant so that it can be used by policymakers. I would think about adding explicit costs of central bank intervention, at the endogenous emergence and role of non-banks, have binding regulatory and leverage constraint, and add a quantitative discipline and match in order to be able to match structural changes that we have observed in the financial architecture. Thank you.
Super, thank you. Great. Franklin, would you like to take a minute or two to
Yes,
answer
that would be
Adrian's
great.
comments?
First of all, Adrian, thank you for a wonderful discussion, very helpful indeed. So let me just make a few comments. So this is why I said at the beginning of the presentation that the political economy of banks is very important. So that's what we've got as the problem that's being solved by the non-banking system. But you're right, there are many other ways to motivate that, and we should probably not rely fully on that. But that's what we see as to why, if you look at the empirical paper that I quoted, that seems to be the explanation as to why non-banks in the US have very different kinds of leverage ratios and so on than banks do. I think this issue of whether non-banks will be bailed out. So, in fact, G Capital was bailed out in the sense that during the financial crisis, it was given a credit guarantee. So, and that's why if you look at large non-banks, they look much more like banks, because I think the assumption is that they will be bailed out, that this is something where they're systemic and the government will step in, especially if you think about what happened with Silicon Valley Bank and so on. So that's implicit. You're right that there are other ways of motivating things like equity versus debt decisions for banks and non-banks, and we'll think hard about them, because what we want is a fairly clean model. I think at the stage that we're at, we're not trying. You're right. We make too many policy claims and things. This is a very simple way of thinking about things with not a lot of real-world details, which I think ultimately one would need to make the decision which is being made. Should we have a CBDC or should we rely on stable coins? That's a very complicated decision with lots of implications. One of the things that's missing from our model, which I think is very important, is public institutions, by and large, don't make good innovation decisions. So I think the US payment system is an example of that. It doesn't work very well. It hasn't evolved in a good way in the way that it has in Europe, for example. It's still very much like it was many years ago, although it's updated in terms of now instead of shipping the checks around physically, you have electronic images of them and so on. So I think that's another important thing. And what the private sector is really good at is innovating. And the whole cryptocurrency story is a good example of that, because it came out of nowhere and worked that way. But certainly, please send me the slides. We'll think very carefully about the points you raised. Thank you.
Thank you. Private sector, that's one of the clue words here. We open up for questions. Do you have any questions or comments? Let's start there in the back, please.
Thanks a lot for the interesting presentation. Ben Hartung, ECB, working in market operations. I had a bit similar questions actually to the very good comment that you received on basically the dynamics between banks, non-banks, and the central bank providing monetary innovation. And I think what I was also missing a bit was the understanding where essentially the trade-offs lie, because at first glance I would think, okay, the best thing is if the central bank just provides this monetary innovation. Obviously in practice that's unlikely to happen. But then what I was wondering, in your model, also with the caveats that you mentioned, what would happen, for instance, if the monetary innovation would not happen on the non-bank side, but on the bank side, actually? So if the banks would actually come up with, for instance, stable coins or other private money that offers a benefit to payment services. Because if I understand the model correctly, then these very leveraged banks that have this bailout, say, social welfare costs to them, they would attract more market share. So that there the effect might actually be ambiguous as well. So that's one thing I was wondering. And similarly, I wasn't sure if you would have two effects at the same time. So for instance, there was a CBDC, but at the same time, there was also a non-bank alternative to that. So what would a horse race of that look like in terms of market shares and market dynamics? Thanks a lot.
So thank you. That's a very important point you make. So I think in these kinds of simple models, there are a whole lot of things being aggregated. So, I think one of the big issues is about payment systems, and then the other is how you make savings. So this is sort of very much in the Friedman-Schwartz view of the world, that the problem with the banking system is that it has the payment system embedded in it. And I think one of the things that CBDCs give is to put the payment system in the central bank so that you don't have to worry that your payment's not going to go through, there's going to be a failure. All of the things that Friedman-Schwartz kind of pointed to as being the problem in the US in the late 19th, early 20th centuries. And if you think about things that way, the notion is that you wouldn't have your account to make savings in the central bank. You'd have it to make payments, and then you put your savings in the capital market. So you put it in mutual funds and so on. So if you think about how some people run their lives today, you make your payments with credit cards, and then once a month you pay off the credit card. And that's the kind of world I think that we're thinking about here. Capital markets seem better at making investment decisions and resource allocation than banks or central banks. And I think that's ultimately what we're trying to do. And that relates to some of the questions that you asked, which is a deeper question, but it essentially evolves around how do we think about banks? And we tend to combine payment system issues with savings issues. But I think the key point is that you can do savings things through non-banks like mutual funds and things like that.
Great. Other questions? Okay, please here in front. Thank you.
Hello, so Société Générale again. How do you see the impact of stable coins on capacity of banks to retain deposits? Because it's a means of payment, okay, but contrary to the Visa card or to any other payment transfer possibility, they need to have a segregated amount of cash to be able to function. So when you issue stablecoin, you put aside this amount of cash. So what do you think this will have an impact?
So I guess this relates to the last question, some of the other points that Adrian raised, which is, stable coins are another way of making payments. They tend to be advantageous because you get instantaneous settlement de facto. You don't have to wait T+1, T+2, or whatever the markets are doing. And I think that's an extremely important aspect of them. Now, the question of whether you actually need cash in your bank account relates to that. Would you need to hold stable coins to make payments? So as I was saying, I mean, the ideal way to do things is to have some kind of mechanism to make payments, which we now have a number of, where you don't have to have cash. And so that would be the efficient way to do it. And then you use the money to go into interest-bearing or capital gains and equity and that side of things. So quite how we innovate and how we get systems which have the advantage of settlement very quickly and payment very quickly and economize on the use of actual cash holding things in bank accounts, which effectively are how banks to a large extent fund themselves. You have zero interest, but you need to keep the cash there. There are ways to minimize that now, and as we go through, and if credit cards work differently so that you couldn't just carry a balance and then pay it off and it doesn't cost you anything, then it may well be that we have much more efficient ways in terms of handling cash. But stable coins, I think, are very important for large-scale transactions. Whether they will be for small-scale transactions, I think that's something that there's still a huge amount of opportunity for innovation. So if you look in China, things like Alipay and WeChat Pay are very different and interesting ways of dealing with those issues.
Okay, thank you.
Great, thank you very much. Everybody else was very disciplined in terms of timing, so we move on. Thank you for the questions, thank you for the presentations. So the second paper will be presented by Gabriele Laspada. It's Banks Balance Sheet Cost Monetary Policy and the ONRRP, and it's co-authored with Gara Afonso and Marco Cipriani.
Okay, so good morning, everybody. First of all, I want to thank the conference organizers for including our paper in the program. It's always a great pleasure to come to the ECB, and for what I work on, I can hardly think of a better conference than the ECB Money Market Conference. So the title has changed slightly. It's the same paper. Some of you have already seen it. It is that we believe, it's fine. We believe it's just more general than not the UX experience and the NRP that John has mentioned previously in his speech. Joint work with Gara Afonso, Marco Cipriani, my colleagues from the New York Fed. Usual disclaimer applies. These are our own personal views. They do not necessarily reflect the views of the Federal Reserve System or the New York Fed. So what is this paper about? So the starting observation for this paper is that monetary policy interacts with bank regulation. Okay? When I say bank regulation here, what I have in mind is all those types of regulation that introduce balance sheet costs in the banking system. So think SLR, supplementary leverage ratio, all these things that penalize balance sheet expansions financed by debt. Okay? So how does it work? Think of QE. When QE is done by purchasing assets from non-banks, what it does, it expands banks' balance sheets, okay, injecting large amounts of these very safe, low-margin asset reserves, central bank reserves, into the banking system. And these reserves are going to be backed almost all the times by various combinations of deposits. So what it does, it tightens banks' balance sheet costs, balance sheet constraints. Now, there is a growing literature on this interaction between monetary policy and this kind of bank regulation that looks at bank behaviors, in particular bank lending. So my discussant, Himing Ma, has an excellent paper in the JFE. I encourage all of you to read it if you haven't done so yet, in which he shows that large injections of reserves crowd out bank lending. So in this paper, we take a different route, and we look at the MBFI angle. And specifically, we ask the following two questions. So first, what are the effects of this interaction between monetary policy and bank regulation on non-bank financial institutions? And here, when I talk about MBFIs, what I have in mind are those MBFIs that compete with banks in the deposit market, going a bit back to Franklin's presentation. And the second question is, if these MBFIs have access to the liability side of the central bank's balance sheet, how does this interaction affect the composition of the central bank liabilities? So, and why do we care about these two questions? Well, I think Franklin's presentation before just set the stage for this. Well, because answering these two questions is actually at the core of addressing the broader, bigger picture question, which is, should the central bank provide access to the liability side of its balance sheet to non-bank actors in the first place? Okay, so think about stablecoin issuers, whether they're fully private or they're asking for access to the central bank balance sheet, CBDCs, even the idea of a narrow bank. All these policy topics we're talking about, they all revolve around the same idea. And in this paper, we're trying to make a simple empirical contribution in that direction by studying how monetary policy and bank regulation interacting with each other affect MBFIs and the usage of central bank facilities. So what do we do exactly in this paper? So this paper is going to be very US-centric, apologies. The sample period that we look at is 2020-2021, so a period characterized by large injections of liquidity, so large QE operations in the response to the COVID pandemic. we are going to need some source of exogenous variations in balance sheet costs, and in particular, we're looking at the SLR. So what we're going to use is this episode that I think Jeremy mentioned also yesterday in his keynote speech, the SLR relief of 2020-2021. What happened then, basically, for 1 year, regulators, bank regulators, exempted reserves and treasuries from the calculation of the SLR, relaxing temporarily this constraint. Okay, so we're going to use that exogenous variations in banks' balance sheet costs, which is ultimately driven, however, by the large QE injections. Okay. Then MBFIs. What MBFIs are we looking at? So I said those that compete in the deposit market, and so far, until now in the US, the main competitors are money market funds. And they play an important dual role in money markets in the US because they compete with banks in terms of deposits, offering deposit-like products to depositors, but they're also the main providers of short-term liquidity to banks in the wholesale market. And both roles are going to be key. We're going to look at two aspects of money funds, so the size of the industry, and then their portfolio decisions, and in particular, the decision to invest part in their portfolios in the overnight reverse repo facility at the Fed. So this facility that we introduced back in late 2013, that is open to this important MBFI. Our results, so this is going to be an empirical paper, of course, but also an identification paper. So let's switch gears. What we're showing is that when banks' balance sheet costs go up because of these large injections of QE, of reserves due to QE, well, the money market fund industry grows. And the idea is very, very simple. If your balance sheet costs increase as a bank, you have an incentive to shed deposits, and these depositors will find a way into money market fund shares because they're the closest substitute. Fact number one. Second main result, when banks' balance sheet costs go up, they also have an incentive to reduce their wholesale short-term borrowing, and then their main providers of wholesale liquidity have to do something else with their cash. So they're going to repivot, ceteris paribus, towards the deposit facility or whatever, deposit-like facility that they have with the central bank, in our case, overnight RRP. So those are the two main facts that I would like you to take away from this. We also identify additional drivers of overnight RRP take-up or this deposit-like facility take-up open to non-banks at the Federal Reserve. And there are interest rate risk and the supply of government bonds. So higher interest rate risk and lower supply of T-bills, both are going to push overnight RRP take-up up. So they're going to give MBFIs an incentive to place their cash in an overnight deposit-like facility at the central bank. Okay, so this paper is really grounded in institutional details, so you have to bear with me for a few slides because I have to go over all the institutional background. I know my boss doesn't like all this, but I have to go through it anyway. So let's start with balance sheet costs, supplementary leverage ratio. That's what we're after here. What are balance sheet costs? These are all the costs that penalize, that are proportional to the bank's balance sheet size. So they're going to penalize balance sheet expansions financed through debt. Okay. I would argue that the most important one, at least in the US, is the supplementary leverage ratio. How does it work? It was introduced by Basel III, and it's the ratio between Tier 1 capital and total assets. Okay? That needs to be greater than a given minimum requirement. So what are the key aspects of this object? Number one, the assets at the denominator are not risk-weighted. Okay? So this constraint particularly penalizes balance sheet expansions aimed at financing either very safe low-margin assets or, in particular, safe intermediation. So think of reserves and repo intermediation in the treasury market. That's key. Second thing that I'm going to use for this paper, it's very important for us, the assets of mutual funds affiliated with banks. So several banks in the US sponsor mutual funds, have affiliated mutual funds. Well, those assets are not included in this ratio, the denominator. And this is going to be key, of course. Okay, so let's talk about the relief episode. So on March 2020, again, Jeremy went over this. I don't need to spend much time. You all know that there was severe distress in money markets, in the treasury market in particular. So at one point in March 2020, actually, the Federal Reserve started injecting lots of liquidity in the system. In a month, I think, from early March to April 1st, we injected roughly $800 billion in reserves. Okay? And we kept doing it in April to reach almost $2 trillion of reserves injected in less than 2 months. Unprecedented. It kind of worked, of course, it did work, but at the same time, regulators realized that they were tightening massively the balance sheet constraints of the intermediaries, of banks in particular. So they announced a relief, temporary relief. How does it work? Reserves and treasuries were excluded from the denominator for 1 year. So the relief was announced on April 1st, 2020, became effective, at least for DIs, in June 2020. And it was set to expire at the end of March 2021. All this was announced at the beginning, so the expiration date was known to everybody at the beginning. What was the goal? By relaxing this constraint, the goal was to facilitate bank intermediation in basically in the repo market and the treasury market. I want to convince you that it actually had a material effect on banks' balance sheet cost. So here I'm plotting the time series of the SLR for the G-SIBs in the US from 2018 to the end of 2021, quarterly frequency. And first of all, so the two vertical lines represent the introduction of the relief and the end of the relief. So first of all, you see that the SLR goes down, starts trending downward in the first half of 2020 as we started injecting reserves through QE and getting closer to the minimum requirement, which is the horizontal dashed line, 5%. Then, as the relief is introduced, of course, the SLR goes up, so it's relaxed. Banks are further away from their minimum requirement. But as soon as the relief ends, following quarter, the SLR of all G-SIBs goes down back, much closer to the minimum requirement. So that's what we're going to focus on in this paper. We're going to use the end of the relief to make sure that our results are not contaminated by the money market stress of March 2020. And we're going to take the permanent shift in balance sheet cost, basically went up for all banks, as our source of exogenous variation in balance sheet cost. So the end of the relief, SLR goes down for everybody, balance sheet constraints are tighter. Okay, the NBFI part of the story, money market funds, well, as of the end of March 2020, so roughly our sample period at $5 trillion in assets under management, now they have almost 8. They're clearly the largest cash lender, except for banks, in the US economy. Two types, government funds, they can only hold government securities and repos collateralized by government debt or agency debt. And then you have prime funds, they can do all of the above, but they can also lend to the private sector through unsecured debt contracts, both financials and non-financials. So you have certificates of deposits, commercial papers, also local authorities through floating rate notes. And those is about the type, so what they can do with their portfolio. So why are they important? Because they're the main alternative to banks in the deposit market for depositors, but they're also the main providers of liquidity in the wholesale market to the banking industry. The kind of institutional thing that I'm going to use in this paper is that 30% of the money funds in the US are affiliated with bank holding companies, okay? And finally, last but not least, this deposit-like facility open to non-banks in the US, the overnight RRP. So how does it work? So it's an item in the liability side of our central bank, of our balance sheet. So through this facility, a bunch of counterparties can invest at the Federal Reserve through overnight reverse repos collateralized by treasury securities, okay? Eligible institutions, of course, banks. Then you have primary dealers, but then you also have government-sponsored enterprises, federal home loan banks that John was mentioning before, and money funds. The rate is set by the FOMC in the communication of the monetary policy stance. And why do we have it in the first place? And the idea, as John mentioned, is that you want to have a firm floor of money market rates by providing these important non-bank money market lenders that do not earn interest on reserves a fixed rate, okay? An outside option with a fixed rate. So, as I said, it's a liability on our balance sheet, which means that if we hold the size of the balance sheet constant, if this liability goes up, reserves have to go down. And the reason is that investment in the overnight RP works through the banking system, through custodial banks. Okay? So money funds instruct their custodial banks to make the transfer. This is the overnight RP take-up over time. We saw it already, so I don't need to spend much time about it. Volatile, it can be very material in size, from a few $100 billion up to more than $2 trillion if you extend this chart further at the end of 2022. It drains, it disappears as we drain liquidity from the system. So we have this object that is very material, this liability item, can be very material, as large as reserve balances basically, and fluctuates over time with the total amount of liquidity in the system. And money funds are by far the main users, more than 80%, 90% during periods of high usage. Okay, let's get to the results. So that was the institutional background. I told you, I apologize for making it so long, but it was kind of needed. So the first result is about the size of the NBFI sector that competes with banks in the deposit market when banks' balance sheet constraints go up, arguably because of QE. So the idea is that increased balance sheet cost give banks an incentive to shed deposits. These depositors will find their way into money market fund shares. We're going to use the end of the SLR relief as this permanent increase in banks' balance sheet cost as exogenous variation. And what's the identification strategy here? The idea is that the effect should be stronger for those money market funds that are affiliated with banks subject to the SLR. Why? It's pretty simple, because banks have an incentive to retain their customers within the same group. And from the customer's perspective, I have no switching cost, basically. I have no switch cost. I just move my cash from the bank deposit into the money fund share affiliated with the same group. Before we get into regressions, I'm an empirical person. I believe in raw data. This is just raw cumulative flows in two groups of money funds over time, from January 2020 until the end of 2021, money funds affiliated with banks subject to the SLR, and all the others. So standalone, affiliated with banks not subject to the SLR. The blue line is for those affiliated with SLR banks, and as you can see, around the end of the relief, their cumulative inflows started to increase, while for the other group, the cumulative flows were practically flat. The flows started to increase earlier in the first quarter of 2021 because the end of the relief was announced at the time of its introduction. So that's just data, of course, and so we have to do things a bit more formally. So we implement the same identification idea in a regression setting. It's going to be a panel regression at the daily frequency fund level. In a nutshell, on the left-hand side, you have daily flows in each fund. And the main objects of interest are going to be two interaction terms in which your treatment variable, the fund, the dummy, will be a dummy for whether the fund belongs to an SLR bank or not. And you have two time dummies, the quarter before, ahead of the end of the relief, and the quarter right after. You're going to have time-varying fund level control, so to have fund fixed effects and fixed effects. I'll briefly talk about identification. But the main result is in column 1. Basically, in the quarter ahead of the end of at the end of the relief, funds affiliated with SLR banks experience additional inflows per day of 33 million, per day each fund. In the quarter following the end of the relief, the effect is positive but not significant, but it's still 22 million per day per fund. When you aggregate that, since this is just daily levels, daily values, and there are 100 funds affiliated with SLR banks, over 6 months, that's an additional inflow of $360 billion, which is not a small amount. Column 2, we test that the parallel trade assumption is satisfied. In column 3, we check that it's not something that has to do with being affiliated to any bank. It really has to do with being affiliated with SLR banks. And then we repeat it just looking at government funds, which is the largest segment of the industry, to make sure that it was not just a quirk of prime versus government funds. But identification, so how do we actually nail it, in my opinion? Well, we use, again, in institutional detail, a differential regulatory treatment of custodial banks. So custodial banks in our sample are SLR banks, so they're subject to the SLR, but they were already exempt from using reserves in the calculation of the SLR ratio in April 2020 in a permanent way, which means that they were way less affected by the end of the SLR relief than other SLR banks. So what I should see that in funds affiliated with custodial banks, the effect is not there, or if it's there, it's very small. And all of the effects is actually in SLR banks that are non-custodial. And that's exactly what we get with this test. So that's what this table is showing you. There's a second way to strengthen identification, and it's the intensive margin. They say, we have data on the SLR of these banks. We know how close they were to their requirement, the minimum requirement. So I would expect that the incentive to push depositors away is going to be stronger for those banks that are closer to the requirement, which means that the inflows should be larger for those money funds affiliated with banks whose SLR is closer to the minimum requirement. And that's exactly what this regression does. You restrict the sample only to money funds affiliated with SLR banks. You use the intensive margin, and you show that for a 10 percentage point drop in the SLR buffer, affiliated money funds get an additional increase of $50 million in inflows per day. Okay? So very sizable. Now, let me move to the effect of balance sheet cost on fund portfolios. So the first part was on size. Balance sheet costs go up because we do QE, so they tighten. Banks have an incentive to push depositors, and this NBFI sector grows. What about its portfolio decisions? The idea, again, is simple, as I mentioned before. The idea is that if my balance sheet costs go up as a bank, I want to reduce all forms of debt. I'm going to push maybe depositors away, but certainly I'm going to reduce the amount of borrowing I do in the wholesale market, so less repo borrowing, for example. And that means that money funds now have to find an alternative. And ceteris paribus, they should tilt their portfolio towards the overnight RRP. So again, we're going to use the end of the SLR relief as this exogenous permanent increase in banks' balance sheet cost. And what's the identification strategy in this case? Well, in this case, it has to do with what you can do with your portfolio, right? So we're going to say that the effect should be stronger for government funds. Why? Well, very simply for two reasons. First, they have fewer investment options. They can either own all the government debt or repos backed by government debt. And secondly, in a more subtle way, because the increase in the balance sheet costs through the SLR for the banking industry is particularly costly when we think about repo intermediation. So doing a matchbook repo intermediation for our banks is going to be particularly costly under a tightening of this balance sheet cost, so a decrease in the SLR. And government funds can only lend to the private sector through repos. So they were particularly penalized. Okay, again, let's start with the data, just raw data. Here I'm showing you the percentage of fund portfolio invested over an IRP in two groups, government funds and prime funds, from January 2020 until the end of 2021. Blue line for government funds, red line for prime funds. So as you can see, basically until the end of the SLR relief, so the two vertical lines always represent the introduction and end of the SLR relief. So until the end of the SLR relief, the percentage of portfolio invested over an IRP is practically zero for both groups. Okay? However, after the end of the relief, the line for government funds started increasing much more rapidly than the line for prime funds. So the percentage of portfolio invested over an IRP seems to be much larger for government funds than for prime funds. Just data, of course, so let's do it in a regression setting. The idea is very simple. Again, you're going to have daily percentage of portfolio invested over an IRP in each fund, and you're going to regress it against the main variable of interest is going to be the interaction between your fund level treatment, so whether you're a government fund or not, and a time dummy, which is now is a dummy for after the SLR relief because I'm looking at a stock variable on the left. It's just share of assets you are holding in your portfolio invested at the central bank. We have to control for these month-end spikes that you all know about because the effect in relative terms in the portfolio may be different from prime and government funds. And then we're going to have fund level time varying controls, fund fixed effects, time fixed effects. Long story short, after the end of the SLR relief, government funds increase their share of their portfolio invested with the central bank by 20 percentage points more than prime funds. The parallel trend assumption is not violated, so let's talk a bit about identification again. What we're going to do here in the first case is going to be, again, exploiting the intensive margin. Now we look just at government funds and we ask ourselves, okay, which of these guys are going to be more affected? As I said before, those guys that mainly rely on private repos to manage their cash in their portfolios. Because private repo intermediation was the one that was particularly penalized by the tightening of the SLR constraint. And that's exactly what column 3 in this regression is showing you. That the share within government funds, the share invested at the central bank increases relatively more for those guys that were relying more on private bank repo borrowing to manage their portfolio. Added two pieces of evidence to make sure that we're after the right thing. So repo rates declined right after the SLR relief, and they went up during the relief, which is telling you it's a demand shock in terms of borrowing, okay? It has nothing to do with the money fund size. It has all to do with the banking side of the story because prices went up when balance sheet constraints were relaxed. So banks were willing to accept higher rates, but then they went down as soon as the balance sheet cost became tighter again. The other piece of evidence I find very convincing, again, uses an institutional knowledge, a bit of institutional knowledge. There are some repos that can be netted. So this is called the sponsor repo program in the US. These repos are nettable, which means that they take no balance sheet space, they're balance sheet neutral, so they were not really affected by the SLR relief or the end of the SLR relief. So we look at the portfolio of money funds, and we compare those repos that could be netted, so they were not really a cost for the banking system after the SLR relief ended, and all the others. And the nettable repos are flat, as you would expect. All the action is in those private repos that could not be netted by the banking system. So it's really about the banking system and tightening of balance sheet costs. Fantastic. Of course, there are other two things that everybody has in mind. Jeremy certainly had in mind yesterday when he talked about the treasury market disruptions. And these two things are the treasury market and interest rate risk. So why? So these two factors could confound our findings because of the following reasons. So when interest rate risk goes up, so you have these MBFIs, money market funds, they're issuing deposit-like claims on the liability side. In order to do that, you have to hold debt, right? That's what they do. They hold debt contracts, which means that they're exposed to interest rate risk. When interest rate risk goes up, for example, if we start tightening and monetary policy stands very fast to fight inflation, as it happened around the time a bit later, well, they have a duration risk they have to manage, so they want to shorten the duration of their portfolio. So ceteris paribus, they're going to go to any overnight investment, including the overnight RP. So you should expect larger overnight RP investment in the face of higher interest rate risk. T-bill supply goes a bit the same way. These guys are offering these money-like assets, these money-like claims on the liability side. They're for sure going to invest in government bonds. If the supply of these government securities goes down, they have to find something else. Ceteris paribus, they're going to park more of their portfolio at the overnight RP. Why does it matter for our identification? Because both effects are going to be stronger for government funds. For the same reasons I gave you before, because they have fewer investment options. These are the only things they can do. So we re-estimate everything, including, of course, the interactions of these exogenous external time-varying factors with our treatment dummy at the fund level, so with a government fund dummy, and our results remain valid, they hold. Of course, we also find that both government bond supply and interest rate risk, which is captured here by the MOVE index, are important determinants of overnight RP. But they do not explain away the importance of banks' balance sheet cost. The final thing, and then I want to conclude, we re-estimate everything. So far I showed you the portfolio in percentage terms, right? The portfolio composition. A question for us, and in general for monetary policy implementation is, well, what about dollar terms? If I put everything together, what's going to happen? So we re-estimate our regression setting, looking at dollar investment at this deposit-like facility for MBFIs, for money funds, overnight RP, putting together all the pieces. So the piece that has to do with the growth of the industry, so whether funds are affiliated with SLR Bank, the piece that has to do with whether you're a government fund or not, plus interest rate risk and government bond supply. And what we obtain is that the effect of balance sheet cost, banks' balance sheet cost, on the dollar investment of money funds at the overnight RP is very material. So after the end of the relief, funds affiliated with SLR Bank invested $1.2 billion daily per fund more, and government funds $7.8 billion. Okay? So the effects are very material, and they explain a lot of the take-up. Okay, so here are the conclusions. Higher banks' balance sheet costs caused by large QE injections. Well, they have two effects on BFIs competing in the deposit market. They're going to make that industry bigger in size because investors are going to move from deposits into money fund shares. And they are going to tilt the portfolio of these MBFIs to the central bank if they have access to the central bank. So QE and QT interact with bank regulation, affecting the size and portfolio of MBFIs. And I want to leave you with a question. So basically, going back to Yiming's paper, right? She shows that when you do QE, then you may crowd out bank lending, right? Because of a tightening of balance sheet cost. But now if MBFIs have access to the central bank balance sheet, and these MBFIs are competing in the deposit market, well, banks can actually drain reserves because they can use the overnight RP, if you want, as a safety valve, push depositors away. These depositors will go into money funds. They're going to get bigger. Banks are going to borrow less from money funds, and money funds will have nothing to do than just parking their cash at the overnight RP or whatever deposit facility, draining reserves from the system. So does it improve or deteriorate QE and the effectiveness of monetary policy transmission? We don't know, but I think it's an important question. Thank you.
So then Yiming Ma for the discussion.
That's great.
All right. Hi, everyone. It's really always a pleasure to be at the ECB, to see many friends, new and old. It's also a great pleasure to read and learn from Gabriella's paper, from whom's papers I have really learned a lot over the years. So these are just my thoughts on the paper, but let me motivate maybe just the setting, just to show how important this question really is. I guess for this audience, this is pretty clear. There's really a lot of reserves in the system. This is true in the US. Reserve balances have exceeded 4 trillion once upon a time. They've come down a little bit, but as we heard from Jay Powell, they're going to restart again the increase of reserve balances. So it's definitely something that is here to stay. The US is not alone. The Eurosystem has even more in total size of the central bank's balance sheet. And so this is a phenomenon that is really common across jurisdictions. So given that, it's of course very important to understand the implications of this large central bank balance sheet. And there's been a lot of work on that. I think the first set of papers on QE have focused on the asset purchases. And maybe many of you in the room have contributed to that understanding. But I think more and more, I think there's a second set of literature that is trying to understand what is the impact of reserve injections in the system. Okay. And so reserves are a special asset because they're very liquid, but they can only be held in the banking system. Right? And so what that means is that if you have one additional unit of reserves, then that is something that has to show up on the asset side of bank's balance sheet. And as Gabriela so kindly mentioned, we have some work on that, meaning that if these reserves take up balance sheet space, and if balance sheet space is costly, then maybe banks can do less of the other things they could have done with their balance sheets, including lending. Okay. Now, there's another side of banks' balance sheet, of course, and that is the liability side. And what happens to the liability side depends on who was selling these treasuries or mortgage-backed securities to the central bank during QE in the first place. In the US setting, a lot of the treasuries that were sold were not originally held on banks' balance sheets. So think there's a hedge fund or an asset manager who wants to sell the treasury to the Fed, but the hedge fund doesn't really have an account at the Fed directly. So the Fed is getting a deposit at the bank, and the bank is getting a reserve from the Fed. And what that means is that this increase in QE would expand reserves and at the same time expand deposits. I believe that channel is relatively weaker in the euro area. If banks are holding more of the securities that were sold in the asset purchases, then that means the expansion of deposits is relatively less. Right? But nevertheless, there is some degree to which banks' liabilities are expanding. And Jeremy yesterday alluded to this, and there's some discussion about what does that do to the liquidity demand of the banking system. Does it increase, does it decrease liquidity demand? With some co-authors, also Christian from the New York Fed, we have some work on this recently, thinking that, well, maybe the people who are coming in as depositors doing QE are not really the same depositors that have always been in the bank, right? So if people who were originally holding onto securities, these are institutional depositors, these are probably much flightier depositors than your mom and pop investors who were always in the bank. So if that is the new influx of deposits, maybe the resulting deposit base is changed in composition, is changed in degree of flightiness. Right? But that all is to say that this is a literature about how the banking system is affected by reserve injections. And I think Gabriela's paper is very important because I think it also sheds light on the fact that it's not just banks that are structurally changed. It's also non-banks that we want to think about, because non-banks and banks, they are interacting in many important ways. Right? So I see this paper as a very important contribution in helping us understand what is the impact of non-banks when banks are getting a large supply of reserves and when these reserves are counted in leverage requirement, in particular in the supplementary leverage ratio. Right? So that's why I think it's a really important paper. And as Gabriela already very nicely explained, there are two main results. The first one is if banks have a lot of reserves, these reserves are costly to hold, they're going to want to shrink their size of the balance sheet. One way to do that is to cut deposits by offering lower deposit rates, for example, and deposits and money market fund shares are substitutes, so that's going to shift funding to money market funds. Banks can also reduce their balance sheet size through reducing the amount of wholesale borrowing they take up. In the US, one major form of that is the tri-party repo that they are borrowing from money market funds. And if they're borrowing less from money market funds, then that is shifting money market funds' investment opportunity set. And if money market funds now can lend less to the banks, maybe they're going to lend more to the Fed through the overnight RRP facility, which is essentially the Fed is borrowing repos from the money market funds. Okay, so these are the two main results, and I think they're very convincing. The identification, I think, is very clean. So I definitely recommend all of you to read, I think, this important paper. I really don't have anything to quibble about the execution. I think I just wanted to talk about maybe two main thoughts. Usually I have 3 points in my discussion. This time I really couldn't think of a third one, so just two thoughts on the big picture takeaway of the results. Right? So the first one is about how to think about the role of QE versus the balance sheet costs of reserves, right? So the paper essentially is comparing, the effect from banks who are subject to the SRR and those that are not, right? Meaning that to have an effect in the results, you both have to have a large amount of reserves, and these reserves have to be counted in the leverage ratio requirements, right? So I think it will be interesting then to understand, well, how much of what we see in the paper is due to the fact that there are large reserves outstanding, and how much is due to the fact that reserves are costly to hold because of regulatory requirements, right? Because even without regulatory requirements, the bank is doing a portfolio choice where it probably doesn't want to invest everything in reserves. So I think it may be helpful to shed light on the magnitudes of which of these two channels is contributing how much. Right? So what I mean is, on the asset side, again, you think of QE as an injection of liquidity, an injection of reserves. Even without any balance sheet costs, banks may not want to just hold all reserves and become a narrow bank. So they're going to choose optimally, how to adjust their balance sheets and how much of other assets they're going to hold. Now, that marginal cost, marginal revenue consideration is going to be tilted by regulatory costs, because if you put an additional tax on holding reserves, then banks are going to want to hold fewer in these reserves. And more of the liquidity, you can think, is going to shift it onto money markets funds balance sheets in the form of overnight RRP take-up, right? So in that sense, I think it's helpful to understand how much is it just because there's a lot of reserves, right? And in the figure that you see here, you see the top line, the blue line is the total amount of reserves outstanding, and then the bottom line, the dotted one, is the uptake in the overnight RRP. You can see that they're very positively correlated, right? So how much of this is just because, if you inject a lot of liquidity, the liquidity wants to go and be equivalized across different sectors, and how much of this is because, the sector that you're injecting the liquidity into, which is the banking system, is very constrained by the leverage requirements, right? So I think it would be nice to maybe have a breakdown of magnitudes. This is for the asset side. I think this also holds for the liability side. Again, there is this substitution between bank deposits and money market fund shares. And here you want to think that, again, if there's just QE without any regulatory requirements, banks probably also don't want to just keep a very large balance sheet if their investment opportunities are not getting a high enough return, right? Maybe they want to shed some deposits already, right? But now, if you further impose a cost in terms of regulatory leverage ratio on holding a large balance sheet, maybe they want to get rid of even more deposits, right? And so you see that in the bottom picture, which plots the growth in commercial banks' deposits and money market fund shares, you see that in the two QE episodes over here and over here, there's positive correlation. But you also see negative correlation in other periods of time, which exactly is because of the substitutability between money market fund shares and deposits, right? So here, I think it would be nice to understand, to what extent do reserves push money into money market fund shares, and to what extent does the leverage ratio requirement tilt the amount of deposits that have been pushed into the money market fund system, right? I think the results are all there, but it would be nice, I think, to flesh out those magnitudes. Right, so that's the point one. And then point two is maybe about the implication. So I think Gabriela mentioned the first implication that was mentioned in the paper. I think the other one that was talked about is how, because of this movement between reserves, and you can think the overnight RRP facility, the Federal Reserve's ability to efficiently expand and contract the balance sheet may become more limited. Right. So I agree on face value, that is definitely true. I think if you look at how, the infrastructure works, but I think maybe it's good to think about whether the goal of monetary policy should be to exactly control the volume of reserves, and what, the goal of having the overnight RRP was in the first place. Right. So the overnight RRP was first introduced when the US first came out of low interest rate environments, because the worry is that as the policy rates were lifted, that banks would not pass on these rates to money market funds, right? There's lots of frictions in repo markets. Banks have a lot of bargaining power. So, what if the policy rates get raised, banks get raised their rates, but then they don't pass it on? And so the overnight RRP essentially was to tell the money market funds to say, hey, if the banks are not giving you that higher rate, the Fed is going to give you a higher rate. You can directly deposit, secure it with the Fed, and that also provides an outside option for money market funds to which they can use when bargaining with their banking system. And it worked very well. Rates were lifted. The money market fund overnight rate provided a floor on the system. And so you can think that this provision of the overnight RRP facility, or to have some liquidity supply to the money market fund sector, was to allow the funding rates to be equivalized across the banking system and an important non-bank market, right? And for the price to be equivalized, you exactly need the volumes between the reserves and the overnight RRP to move, right? That was the whole idea, because if you don't have the volume in the overnight RRP and you just have, reserves in banks, it's segmented, it's locked up, it doesn't necessarily mean that the costs will be spread to other sectors, especially if the banking sector is constrained and has bargaining power. Okay, so I think the goal is perhaps at the beginning not to equivalize volumes or to say who has how much in amount, is to exactly let the market determine who has what amount, so that the funding rates across important funding markets can be equivalized. Right? So under that backdrop, I would actually not change anything to the results. I think the results are perfectly fine, but perhaps the takeaway is not that, the overnight RRP or these balance sheet costs makes it difficult for the Fed to control the amount of reserve balances. Maybe we can think of this as that when we decide the amount of reserves or the amount of QE, it is important to consider who has access to the central bank's balance sheet. Right? And I think we've heard this potential trade-off here. Originally I thought I think, but now I think this was now mentioned multiple times. I'm more confident in that opinion. I think there's a bit of a trade-off. You can have a smaller balance sheet and more limited access, but then you're more directly targeting a subset of the economy, which is the banking system, and you're relying on those institutions to transmit the rates across. Of course, this works sometimes and may not in other times. So the other way is to do a broader access, so more total supply, but also more direct control on rates. And so there's the larger supply of this broadly defined central bank money. Right? And I think this paper has highlighted, I think, one step of that. Broadly speaking, you can go from bank reserves to bank reserves as the overnight RRP, but I think this is a more broader question, because you can also then think ultimately, you have access, to stable coins that are now maybe are getting a skinny master account at the Fed, and eventually to even more access by other institutions and maybe even retail, and that will be CBDC, right? So I think this is a kind of trade-off that the RRP has started to illustrate, but I think it's something that is here to stay and that is important to consider. There's one important caveat, and this is definitely last but not least. An important caveat is that the RRP is a safe storage facility. It does not allow these overnight RRP balances to be used as a means of payment. And that is very different from when we think about CBDC and even stablecoin master accounts. And so I think maybe a more refined version of that first line of the interpretation should be that when we decide the amount of reserves to inject in the banking system, we should think about who else has access and who else has access with what kind of functionalities, because both are going to affect how much optimally the banks should be holding, right? So that's all I had. Again, I think important paper to think about the implications of reserve injections, not just on banks, but also on non-banks. And the suggestion is just to think about the effect of QE versus balance sheet cost, how much they each contribute, and also the takeaway, which I think is a very big and broad one, which is we want to think about the system jointly in terms of banks and non-banks, and how much the banks should be getting should depend on who else gets how much of what. Thank you.
So, Gabriele, would
2
you
minutes
like
just
yeah,
to.
absolutely.
So, first of all, Yiming, thanks a lot for the amazing discussion. Fantastic as always. 2 points, right? So I want to touch upon both the level effect, right? The macro effect. So as some of my co-authors know very well, identifying micro things is much easier than identifying macro effects.
I agree.
And so we thought about it. The truth is that we haven't done it, of course, and we will try. I totally agree. That's the first order of importance, because we just very narrowly, I told you it's an identification paper. We think identification is robust, is solid, but then the issue is how much of an first order quantitative effect you guys have. So we will try to do it, because actually by just seeing the charts you put together, maybe a simple decomposition exercise is feasible without requiring too much effort. Doing it super carefully, honestly, I don't know how easy that is.
No, I agree.
I think it's going to be hard. But point taken, I think that's first order importance. Regarding whether the NRP helps or does not help monetary policy transmission, so the quote that you have from the paper originates from when we started writing the paper, right? It was back in 2022, so a few years ago, and overnight RP was still very, very large, and we were trying to understand why is it so large, so that's how we came to write this paper. And back then, the concern was, okay, this thing is so large, is it going to shrink to zero when we start draining liquidity from the system, as it should, and as it did back then in 2017, but you know, in 2016, didn't reach $2.5 trillion, right? So that was the concern. So that's where that sentence is coming from, right? Say, oh, can it create a problem? Okay, because maybe it constrains our ability to drain reserves from the system. The truth is that I personally, my own personal views, do not necessarily reflect the views of the Federal Reserve System, New York Fed, or not, is that actually it helps. It helps because it kind of goes to ameliorate the issue that you identify in your paper, the fact that QE can tighten banks' balance sheet costs and then can crowd out bank lending or other activities. By providing banks with this safety valve, you're actually kind of making their lives easier, right? Because they say, look, you don't really want deposits, you don't really want to borrow wholesale. All these safe reserves are taking this space in a useless way on your balance sheet. Push it out. Someone else will take that liquidity, park it, and drain reserves from the system. So my personal view intuitively is that it's going to help the transmission of monetary policy. That's just my personal view. And on the last comment, yeah, I agree. Two views. You could have probably a linear balance sheet with access only to traditional banks, or you can have a broader, larger, maybe balance sheet with NBFIs too. It's not super clear to me that the first one is necessarily smaller, right? At the end of the day, you still need to provide banks enough liquidity so that money market rates in which they operate do not spike. So intuitively, yes, but you know, I'm not sure. I'm not sure how much of this is driven by the US experience, which we really went big to fight COVID, and we ended up spending a long time deep in the Bonton region. I don't know whether that's necessary as an optimum in the steady state. You know what I'm saying? But it's just my 2 cents.
Super, thank you.
1,
Yeah,
2,
let's
3,
take
4,
questions. Let's start here in the second row.
Hi, Antonio Garcia from Santander Bank. Congratulations, a super interesting paper and also a very illuminating discussion. I learned a lot from both. Just a question perhaps on the policy implication side. You kind of left us with a cliffhanger, but now you gave us a little bit more juice on it, which is it is very interesting. So, look, it is very interesting the part in which how regulation interacts, the access or not of NBFIs to central bank, and that driving your results in terms of the size of NBFIs, the MMFs in this case, and then the change in the asset composition of them. But if we move forward to current situations relative to the natural experiment that you conducted, we are now in this situation in which there's more what we call regulatory simplification in banks, so maybe deregulation. Then there's also obviously an increase in the supply of US Treasuries, short term as well. And there's also perhaps, well, if we measure interest rate risk by interest rate volatility, there's way less. So all these issues that you addressed in the natural experiment is kind of the reverse of it, or the opposite of it. So I want you to, if you can comment a little bit sort of on the policy implications and the current circumstances, whether you actually need even more access to the central bank by NBFIs, not just to the liability, but to the asset side, okay? Whether there's merits into access by some, not all, some NBFIs, maybe UK style, for some institutions to mitigate financial stability issues, so your monetary policy works better and is better transmitted. Are there merits into that, or does your paper speak to this topic?
So there are two parts in this question, the way I see it. The first part is whether what we show in the paper is consistent with the current conditions, and I would say yes. What we identified back then is basically consistent with what you observe now. The overnight RP disappeared, and it is true that now the treasury supply went up, interest rate risk went down, so all the things that push money funds to invest in the overnight RP kind of disappeared, and SLR constraint is not probably as binding as before because we've been draining reserves from the system. So that's the first part, which is more of a statement. Yes, so it is consistent, what we observe now, with what we identify in the paper, which to me is very reassuring. Now, let's come to the tricky part, which is the sort of policy question. Personal views, again, totally personal views. I think that the NRP helps the transmission of monetary policy and the management of our balance sheet, because we are in a very specific money market, which is different from the European one, in which money funds are very large. So in the US, money funds are key. So you want to accommodate for that. Now, asset side, I do think that facilities open to non-banks that are key and target really some important money markets that we care about, those are useful. So SRF, I think it's very useful. And I think the example with the BOE was also very useful. So personally, I'm not against it. I think it's very natural. Of course, you have to set some boundaries. My boundaries would be, what are the markets I really care about as a policymaker in a monetary authority? It's not going to be every market in the world, because that's not monetary authority. So those 2-3 markets that I really care about, I want to target specific institutions. Doesn't matter whether they are banks or something else. That's my view. There's Iman, there's 3, 4. Where do we go?
Okay, Iman as the host. There's a microphone.
Capacity. But just to say, Gabriele, I really liked the paper. I think that using this natural experiment of the SLR relaxation during COVID is an excellent way to quantify the impact of regulatory costs to intermediation, and also how this shifts the equilibrium between banks and non-banks in the financial system. So in Europe, we also had a temporary exemption of the SLR during COVID, but we're probably unlikely now to relax the leverage ratio requirements. I wanted to highlight, and there I also invite some of the senior central bankers we have in this room from other jurisdictions that have deep experience of both banking supervision and markets that may want to come in, so Vicky, Makoto, and others. That also shows the link between regulation and market functioning, okay? And then I have 2 pointed questions. The first one is, are you able, with your model, to quantify the difference of impact between the exemption of central bank reserves and the exemption of government bonds from the SLR? And then what about the NSFR? Because in the Basel rule, there was a weight on repos against government bonds on the NSFR. In Europe, we actually, I mean, we have a permanent exemption from this in the US now, and there are also permanent exemptions in other jurisdictions. In Europe, we had a temporary exemption that was actually falling in June of this year, yeah. And we did really a lot of work with my teams and also with banking supervision to kind of look at, should we prolong or not? We finally decided to prolong, but if there's any result about whether we did the right thing, that's interesting. Thanks.
Okay, so brilliant idea. We didn't think about it. I think it's feasible. I'm referring to the idea of looking at trying to understand whether exempting reserves rather than treasuries is going to have a differential effect. It's not straightforward, but there could be ways to do it. But just looking at the balance sheet of these banks and see whether they have relatively more one than the other, and then corresponding to that, you look at their both deposit activity, affiliated money fund flows, and borrowing in the wholesale market. So you can basically repeat it, having some proxy for exposure, and you see whether it was more important for banks that were holding lots of treasuries rather than reserves. It wouldn't be clean, but we can try. So we haven't done it, but it's something that we could try and do. Now, regarding the NSFR, right? Yeah, net stable funding ratio. I don't know much about it, so I'm not an expert. What my experience from writing this paper and thinking about these problems is that this exemption was very useful. And so prolonging exemptions similar to this in spirit may not be a bad idea. And the reason why I think it was useful, and I think similar to that in spirit, the qualification means, personally, including reserves in the leverage ratio, to me, does not make much sense. That's my own personal views. Totally personal. So to the extent that the exemption in the NSFR is sort of similar or speaks to the same tweaking of an important regulatory constraint, that I understand where it's coming from, things can be improved, right? So if it improves it, improves it.
Great, thank you very much. We have run out of time. I'm really sorry to. Okay, you're the host, and you mentioned Vicky, but all the other discussions, I'm sorry, then later on. Vicky, you go on.
I'm sorry to prolong this. It's just in responding to our kind hostess's very good question. I also really like the paper, and the discussion was brilliant as well. So thank you for that. It is tricky, actually, this interaction between regulation and QE, QT, QN, and the interactions with the central bank trying to maintain monetary control and transmission. Because, of course, there are objectives of the leverage ratio itself. And the objective was, it's non-risk weighted, as you correctly said, but risk weights are not perfect. Indeed, we have lots of examples of risk weights failing. And therefore, the leverage ratio was set by regulators in order to have a backstop, quote unquote, that word again, against the failures of risk weights for resilience reasons. Now, we at the Bank of England have exempted reserves from our leverage ratio, and that was done at the time that we did one of our QEs, or asset purchases, in order not to have some of the effects that you described in terms of balance sheet costs. But, I mean, we need to think, however, also what the impact of this has. I mean, obviously it increases the demand for reserves and it decreases the balance sheet costs, other factors being equal. But also, without also exempting treasury securities from the leverage ratio, it creates an asymmetric incentive in terms of banks extending repo generally to other banks and particularly to non-banks in the world that repo. So there is another consequence of that. So you effectively need a general equilibrium way to try to understand all of this. And on the fact, which goes back to the debate, if I may, given that I have the floor, that we had about Friedman rule and so on, coming back to Isabel's speech, but also it has come up in other contexts, and also the papers by Wissing Jorgensen, which came up in Franklin's paper. I mean, reserves, are they totally costless? I mean, to supply them, you either need the central bank to take on government bond, so interest rate risk, or the central bank or the central bank to lend to financial institutions through repo and therefore take on some credit risk. So you need to think, and by doing so, the central bank takes out certain assets, because the central bank will always lend in a collateralized way, that also have a convenience yield. Mm-hmm. So the Friedman rule needs to be extended for that. And that is also relevant to this debate that reserves are completely costless. Thank you.
So, super briefly or not? Okay, super briefly. The first part, totally agree with you. My statement was a partial equilibrium statement. I didn't even mention anything about treasuries. I just said reserves should not be there. I didn't say whether I think treasuries should be there or not. The reason why I didn't say it is because it's trickier. Because reserves is just money. It's just literally liquidity. Treasuries, they are very safe. People keep saying that they're super safe, but sometimes they're not. And the prices fluctuate. So I can't put them on the same footing in terms of leverage ratio rationale. Of course, if you want to make an optimality statement, it would be ideal to have a GE model in which you take into account the interplay that reserves and treasuries have in money markets more generally, not just from the perspective of being a leverage ratio measure. So I totally agree with you on that. For what concerns Friedman rule and whether providing reserves is costly or not, again, I agree with you. So Friedman rule is optimal in all these models in which you have no frictions. As soon as you start having friction, Friedman rule is not optimal anymore. So let's start from that. So it may not be optimal even now. My perspective is that, so we have this paper with John on the optimal supply and all this theory paper. In a sense there we are a bit agnostic, and the idea is that different jurisdictions may have different considerations. Some people care about political economy, independence, excessive footprint. This will position your target somewhere along the curve, which is not necessarily the flat part. And then the question, I think, is each jurisdiction should have its own pseudo-Friedman rule. And then the framework will be what's the optimal amount of reserves and corridor between deposit and lending facility that allows you to achieve the target. So yes, Friedman rule is not optimal in the real world in a sense, no? Almost by definition.
Great. So thank you very much for this lively discussion. I hoped for it, and there we had it. Let's continue in the coffee break. Thank you all.
So, good morning to all, and welcome to the last session of the conference. Last but not least, as I said yesterday, the market panel. So I'm very honored to have with me today 4 accomplished and distinguished speakers. First, Vicky Saporta. Vicky, you're the Executive Director for Markets at the Bank of England. You held several senior positions in central banking, including banking supervision, monetary policy, financial stability during your career at the Bank of England. You have a PhD in economics from the University of Cambridge. Nicolas Pillet is Group Treasurer at BNP Paribas. His previous roles include Chief Operating Officer of BNP Paribas Investment Banking in Hong Kong, General Manager of BNP Paribas branch in Japan. You graduated from École Polytechnique and École Nationale Supérieure des Mines de Paris. Søren Rade, you're the head of European Economic Research at Point72, a hedge fund. Prior to joining Point72, you were a senior European economist at Goldman Sachs, and you spent over 5 years at the ECB, so welcome back. Søren holds a PhD in economics from the Technical University of Berlin. Lubna Mudanib, you're a senior credit analyst at Vanguard. Previously, you worked at the Financial Services Authority in the UK, and before that, in Société Générale's rating advisory team. And you hold a master's in management and finance from the French Business School. And Lubna is also a member of the Bond Market Committee of the ECB. So let us start, yeah? As a start, after some housekeeping remarks, I'll give the floor to all of you to kick off. But please ensure, and it's my plea, that you stick strictly to the time allocated. We have a wonderful countdown here, yeah? And in popular demand was to give a general disclaimer for this panel that the views expressed by the panelists are their own and not those of their respective institutions. And that applies maybe also to me. So let's start. The first round is about a topic that has really dominated, I think, today's and yesterday's discussion, which is the regime shift in liquidity availability. So as excess liquidity becomes less abundant, what are the key elements that central banks need to get right to ensure a smooth transition from the abundant liquidity regime for financial markets and for banks' funding and liquidity? So let's start with Søren.
Thank you very much, Iman. Thanks for having me on the panel. And let me start off by congratulating you on a really excellent conference. And thank you for bringing diverse perspectives on the subjects that were discussed over the past few days as well to the fore. On that, I'm going to take on my economist hat and probably pick up on some things that Isabel said yesterday in her speech. So what's the red thread really that runs through the transition of an abundant to ample, less ample liquidity regime in the ECB? It's really the desire to transition to a demand-driven system of managing excess reserves, right? Now, I entirely see the theoretical appeal of that approach. You've got banks that come to the operations, you anchor money market rates in your corridor by elastically supplying reserves, and banks reveal endogenously the required amount of reserves required to do so. And through that, you ensure a smooth transition of monetary policy. Now, in practice, I fear that will be a lot harder than it sounds in theory. So what are a couple of issues that I would highlight? One is you need a signal of reserve scarcity either on the price side or on the quantity side. Let's talk about ESTR. Currently, Esther is 6.9 basis points below the DFR. If I look at the spread absorption rate, reabsorption rate, that's about 2 basis points per trillion of liquidity drain. That gets us to something like 6 basis points Esther DFR spread by the end of next year. Now I'm thinking back to the charts you showed yesterday, Isabel. There was one chart, liquidity, excess liquidity time series with projection into the future and a band. That band was sort of determined by where excess demand or scarcity might kick in. And so if I remember correctly, as of the middle of next year, we might be in a regime, according to your scenarios, of excess reserve scarcity. At that point, Esther is not going to signal that if what I just said is true, and we still have a negative spread below the DFR. So what about quantities, where you would focus next, right? So MRO take-up. I think this is the issue that was discussed last year, received a lot of attention this year as well. You've got fragmented distribution of reserves, 900 billion in Germany, 100 billion in Italy still. Are those going to be efficiently redistributed, and who turns up to the MRO? It's going to be the banks that have the least reserves, presumably weaker banks. There's a stigma issue, so what does it mean? Less take-up than you would like to see, and potentially funding in other markets like repo, secured funding markets, that anchor the rates or push the rates above the MRO. So you might end up in a situation with Esther below the corridor, repo rates, at least in some jurisdictions, above, and maybe not a perfect signal from volume. So that's maybe just to set the scene, the concerns that I think need to be addressed as we run up to that point.
Excellent. Nicolas, bank perspective.
Even if time is very tight, I cannot not thank you very much and all the ECB teams for this conference, which is really great. Even if it's a challenge to stand between you and lunch after such an insightful discussions. On stigma, maybe, it's a very delicate question. I think it's very important to have in mind that a very strong liquidity is what all our clients and counterparties are going to expect. And we cannot suffer any form of doubt, any form of question. It's not the conversations that we would expect to have. That's why there is, I would say, abundance of caution on that front. And I would say the bare minimum is to ensure that what we do has economic sense, and that's something that maybe you're going to elaborate, and that was also mentioned by John Williams this morning. Having said that, I want to insist that the facility, for example, MRO facility as it exists currently, even if not drawn, is very useful to the system because it's pushing banks to transform their assets, mortgage into self-retained covered bonds, consumer credits, or sometimes some types of SME credits into self-retained securitizations that have to be ready to be used for this facility. And it's very virtuous because it provides a buffer for each individual bank and for the system as a whole with basically no cost. The third point I would like to touch upon is to take into account regulations and market structure. I think in Europe there is a very big need for more financing, and it happens that in Europe non-financial corporates typically are much more dependent on bank financing than they are in the US. The order of magnitude, I think, is 32% of GDP in Europe is bank financing to non-financial versus 7% of GDP in the US. And the regulation is such that to provide additional loan, it means you need to sterilize part of your liquidity. Each time you provide 100 of loan, of course, you will create deposits, so you will have deposits, but because you have deposits, regulation, LCR regulation, force you to assume that there is a leakage on those deposits and that you have to sterilize part of that liquidity. So we need to take into account the specificities of the business model and have a forward-looking perspective on that. Last one is that obviously, as you mentioned, we need to monitor very closely the repo market. And that's probably where Victoria will go. And you've published very insightful papers on that.
So, Vicky.
So my perspective is obviously as the central banker on this panel, and I do think that a lot of central banks, certainly the Bank of England, the ECB, the Fed, but a number of others, are facing very similar issues in the sense that we're trying to do this quantitative normalization in an environment that is extremely different to the environment when we last thought we were normalized, which was before the GFC. And the environment is extremely different for a number of reasons. One reason is regulation is very different, and we've talked about that a lot in this conference. The second reason is the market structure is very different, and the two things might be related because regulation has contributed to the difference in market structure, but it's not only because of regulation. So non-banks, even in Europe, have, and in the UK, have a much more important role than they used to have before. And the third reason is relative to the pre-GFC environment, there is an abundance of government debt obligations due to much more increased issuance. So we have switched from a world of, if during our QE days, where the early QE days in particular, of the GFC, where we introduced injected reserves, but there wasn't that much collateral, so there was reserves abundance and collateral scarcity, to collateral abundance and reserve scarcity. And this is also a very important thing to keep in mind when we're looking at the repo market and at the unsecured market, and the two are connected. I've published a paper today trying to explain how I think these dynamics in a qualitative manner with some data, but it's not a model, explain the UK circumstances at the moment and link them back to the operating framework. In terms of, we, like the ECB, want to have a demand-driven operating framework when we totally normalize. Our framework is also going to be repo-led. That is, we're going to be supplying the structural, not only the marginal, but the structural bit of the reserves through what the ECB calls refinancing operations. We call repo operations. And therefore, for us, it's incredibly important, almost kind of fundamental or existential, to have destigmatized facilities in order to be able to do that. At the moment, we have 2 weekly facilities. They both settle on a Thursday, market-wide facilities. We have been very pleased that they both seem to be entirely destigmatized now, and they've been taken up. They're weekly. We also have bilateral facilities that are daily and settle at T+0, but it's the weekly operations that have been used more at this particular stage. We are going to be having bumps in the road, and we will have to learn by doing. Some of these bumps are also being driven by the pressures that exist in the repo markets, which are related to what I've described earlier, the collateral abundance, regulatory, reserves draining, if you want, triangle, which are putting pressure on repo rates, which we see in quarter ends, month ends, and Canadian year ends, which, like in the US, are important for us. And we saw one last week in the UK. Repo rates went above 40 basis points. Our facilities were taken up at record levels, and they went down. And banks should be prepared for these types of incidents as we go along the way. Thank you.
Excellent. You set the scene perfectly. So now let's go to a topic that was abundantly discussed from the theoretical side at the previous session, but we're going to ask the people that live through that every day, What are the dynamics between banks and non-banks in money markets? And should non-banks be seen as competitors to traditional banks or as complements? And we're going to start with Lubna.
Thank you, Iman. So as we've been hearing during the conference with central banks' balance sheet normalizing and shift in market structure, non-bank entities are definitely rising in importance, particularly money market funds that have become structurally embedded into short-term funding, providing not only liquidity transformation, but also collateral efficiency. So I would definitely see them as a complement to the banking system, as there is an increasing need for liquidity. So let me focus on the investor demand side. So after exceptional years of investor demand for money market product amidst rising rates and flight for safety, the flows have been normalizing year to date, but remain strong. So they are on the institutional side, they were at almost $166 billion until the end of September, bringing the total asset under management industry for Europe to 2.5 trillion USD. And an interesting trend that we've been observing is the growing interest in this cash-like exposure into an ETF wrappers. So indeed, the European money market ETF category grew from $3 billion just 3 years ago to $32 billion at the end of October. So definitely tremendous growth there. And we've seen 9 billion of inflows year to date. And this demand has been not only driven by retail investors, but also intermediaries. And it has been dominated by synthetic overnight products, but we've seen the first cash ETF product launch late last year, which have been generating nice inflows so far. And looking ahead, as we've been discussing, that liquidity will continue to decrease, we still think that there is a huge potential coming from retail investor side. I mean, the European money market landscape, as you know, is still very much institutionally focused. And as you said, Christophe, like Nicolas, sorry. Big companies with cash reserves looking for reserve management, contrary to the US, where there is a strong culture of US money market product investing for households. So we're working on client education that cash doesn't have to be cash by putting your money in investment products. You benefit from dedicated portfolio management, capital preservation, diversification, and sorry, Nicolas, but providing an improved rate of return over banks' deposits. So just to give you an order of magnitude, we run some numbers using OECD data as of the end of 2024. And we find that for European Union countries, if they were to allocate the excess cash that they have over investment products, a simple reallocation of just 10% of that cash would provide potential liquidity of 660 billion euros. So that's a pretty significant amount. And I'm not saying that everything will go to money market, but it's a natural potential reshifting of that liquidity. And because we are in Frankfurt, I have to mention that the biggest cash saver are German investors, still 40% invested in cash. So look at your bank accounts. And conscious of the time, I will leave it there just with one message that we've seen very strong demand for Euro money market products, and we expect it to continue in the year ahead.
Thanks, Lubna. And you said, I think, two buzzwords. One is that there is innovation in money markets, also in products. And the second thing is money-like assets, and we'll be coming back to that in the third session. So, Nicolas, competitor or complements?
Well, first, I would like to say that innovation and competition is good in general, and we are, of course, favorable to that. The shift in participants is obviously affecting the dynamics. And individuals' preferences are not necessarily the same depending on the geographies. Capital market structure is also very important, and again, regulations. I would tend to answer that we are complementary when we think of all the secured markets. In fact, the regulations are strictly limiting the bank's appetite, and we play a crucial role in terms of market making. And in these activities, hedge funds typically will have a risk appetite that banks are not allowed to have, and money market funds can be very useful also to distribute the liquidity. But of course, we can be also competitors in some segments for unsecured liquidity, and then it's very important to keep in mind that the bank's role in the economy is to channel unsecured liquidity and to have a kind of orderly maturity transformation and a supervised maturity transformation of those short-term deposits to be allowed to provide unsecured credit to the economy. But indeed, we can compete in many segments, especially for talents, by the way.
I'm sure that many of the hedge funds here appreciate the remark. So, Vicky, what's your view?
Yeah, I mean, I agree with what Nicola said. I mean, from a central bank perspective, when you're thinking it from a sort of our roles, EMEN, where we care a lot about market functioning, the monetary policy transmission and operating framework doing this, certainly, and we heard it a lot, we saw the charts in Jeremy Stein's speech yesterday. I mean, it's pretty clear that, that banks are able to warehouse, the repo desks of banks are able to warehouse less risk, so they take on less risk, and in particularly, they do not as much participate in basis trades, asset swap trades, or any other such arbitrage opportunities as they used to do. But they fund these activities through repo funding, and in so doing, they enable the transmission in the secured markets. But also from a market functioning perspective, I think the secured markets are crucial. So I would agree that they're complementary in that sense, but also I would agree on your comment on the unsecured market. I mean, for us as policymakers, I think it is quite important to think about the financial stability implications of all of this. Thanks.
Thank you very much. Would you like any of you to react to what was said on this bank, non-bank divide? No pressure.
I mean, all I can say is, well, you're looking at me.
No.
Compliments would be the view for the most part. But I think I share the remarks that banks have capital cost constraints related to regulation, and so there's probably more demand for intermediation than can be satisfied because there are constraints.
Absolutely. So now we're going to shift to a topic that has been agitating, I think, the policy circles and probably also the market circles in the past few months. And that's the really transformational change that we're about to experience in finance. So, future of finance, future of money, and the rise of tokenization, and more particularly different forms of money in the financial system. And this has first of all, I think there's really a need to define what are we talking about, yeah? I heard a lot of confusion between different kinds of tokenized assets, and we trust that this panel will enlighten a little bit all this landscape that in practice for us central bankers
has potentially a profound impact on many of our central banking functions, on monetary policy transmission, on monetary policy implementation, of course on payments, on financial stability, on supervision, and I'm probably forgetting, geopolitics and basically international role of currencies. So we're going to start with Vicky, who really has the challenge, but I know she can do that, to give us the landscape here and how we should, from a conceptual perspective, think about that. And then we'll go to each of you, and we'll start with Søren, okay, Lubna, and then Nicolas, to give us your top-of-mind thoughts about this transformation and its implications, and maybe your top-of-mind concerns, and keep it to 2 minutes each. Vicky has a little bit longer.
No pressure. So let us think about, before digitalization and tokenization, about what is money. So money is the banknotes in your pocket or in your physical wallet, the deposits banks have with the central bank, which is a thing called reserves, or the deposits other institutions might have with the central bank. We heard of an example earlier, which is on reserves. And then is commercial bank money, which is the money that is the deposit that you have with your commercial bank. So what is the common thing about these forms of money? And one that is central in how to think about digitalization and central to the central bank's raison d'etre is the singleness, is what we call in the Bank of England the singleness of money. That the money, that the note that you have in your pocket, the money that you have the deposit that you have in Bank A, and the reserves that your bank have with your central bank are totally exchangeable and they have the same value. Now, what is digital tokenized money is the digital representation of money that are issued, recorded, and transferred on a programmable platform. So at the moment, there are three main forms of these tokenized money emerging globally: central bank digital currencies, tokenized commercial bank deposits, so the tokenized form of the commercial bank deposits. Central bank digital currencies are the tokenized forms of having your notes in your pocket. And stable coins are privately issued digital tokens, typically hosted by blockchains, but not necessarily, that aim to maintain a stable value by being backed with assets denominated in sovereign currency, which is a form of money. So effectively, they're tokenized representations of what we already have that can sit alongside the other forms. Exactly. Now, how can they work? Well, the fundamental thing is that they need to provide singleness. Now, CBDC, given that it's issued by a central bank, should provide singleness. The tokenized deposits are similar to commercial banks. So then the question is, if you have a systemic stablecoin, which we don't have at the moment, what makes it, what can provide the singleness? And the bank issued the Bank of England, issued a consultation paper back in 2023, which we got lots of comments on, and we're currently reviewing, and we're going to publish another one on Monday, so watch this space, about how to provide the singleness. In our first consultation paper, we said that a systemic stablecoin, to be totally exchangeable with the other forms of money, it needs to be 100% backed up by unremunerated reserves. This was, we got a lot of pushback about the viability of this business model. So what we are now going to propose is, yes, it is going to be backed by a portion of central bank reserves, and as a result, the systemic stablecoins need to have unremunerated reserve accounts with us. But the rest will be, they could have short-term government debt. But importantly, they will have access to master accounts with the Bank of England in order to do that. And that is also for financial stability reasons, which is an explicit objective of the bank, but an implicit objective of many central banks, so to reduce interconnectedness of this form of money to holding the liquid form of monies in commercial banks, because we saw an example of the result of this interconnectedness in March 2023 when a US dollar coin lost its peg to the par value to the dollar because its bank failed. So that's an example of interconnectedness. But also to the extent that systemic stablecoins are going to be competing with the medium of exchange or payments function of banks who do lots of functions, but one of them is the payments function, then you don't have them to rely on their competitors if they are systemic stablecoins. So that is the way that we think about this particular form of digital money.
Excellent, and we look forward to the paper published on Monday. We hold our breath. So, Søren.
Thanks very much. So 2 minutes, okay. I'm by all means not a crypto expert. I'm an economist and a German. That makes me naturally cautious. So if I see projections that we're going from 300 billion stablecoin circulation at the moment to 1.5, 2 trillion over the next 5 years, maybe, but I would put quite wide error bands around that. Now, the one exception I can see from an economist's perspective is, where are stablecoins really providing value? Cross-border payments, right? So that's a natural habitat. They're resolving a problem at lower cost and providing a service that we don't have at the moment. No instantaneous payments. Okay, so if that is maybe the natural habitat I would see as an economist, that's where I would expect the proliferation and the penetration of stablecoin. And now how do I link that back to the ECB? Link is the following. I think it's quite clear that the current US administration intends to use stablecoin as an international medium, dollar-backed international medium, to foster dollar dominance as a reserve asset. So you could imagine stablecoins as a reserve asset, particularly in jurisdictions that have a lot of currency volatility. It has the cross-border payment function. It has probably a function in terms of invoicing. And so it fosters that role for the US dollar. And if I think of sort of a missing piece in that puzzle that is starting to shape up in the euro area, it is that. Where is the European competitor to this specific US dollar-backed stablecoin as an international medium of reserve holdings or payments? The digital euro will unfortunately, at least the way it's conceived now, not play that role. It's accessible only for euro area residents, and it will not, as far as I understand it, satisfy sort of that nature of an international payment medium. So if I had to think of a sort of missing puzzle, it's that. And I can see I'm still on time, so I'm going to hand over now.
But of course, it's all about differences of approach to money, central bank money, commercial bank money, across jurisdictions. Yeah, but I completely see the point. Lubna.
Thank you, and thanks very much, Vicky, for a very comprehensive update of a very vast market. First of all, I just wanted to agree with your point on the dollar reserve assets. And actually the numbers that you mentioned in terms of growth, obviously it's a lot of buzzwords around where are we going, where are we headed. But when you look at where most of the growth has been, it has been mostly in emerging markets, where they wanted this dollar stability rather than the volatility of their own effects. Now, when more traditional asset managers have been launching tokenized product, it has usually been in complex form and very high management fees. So we're still at the very early, I mean, some of the benefits are clear, but we're still at the very onset of that growth.
So you mean tokenized money market funds, for example?
Yes, but tokenized market, I think I'm more talking about other type of tokenized assets, but tokenized money market fund actually has been an interesting one because you still can combine the liquidity and the safety of the traditional money market, but then with the efficiency and accessibility of a blockchain technology. Yeah. So effectively for investors, it means that the potential for instant subscription and redemption, 24 hours, 7 days access, and improved transparency over your underlying holdings.
So in a way, it makes it also very similar to an ETF. I mean, you basically have money on demand. Yes. You no longer have the net asset value concept, no?
Yes, so I think but we're still at the very, asset management industry is still testing the use cases, but that has been definitely an interesting one to watch. I think you said to focus on 2 minutes, and the key top of mind, obviously as a bank analyst, key top of mind is what does it mean for deposits going forward, and how fast, I mean, obviously that's an advantage for client, but what does it mean for financial stability in terms of bank runs, and also, I mean, European banks are still very much deposit funded. I think it's like 47% of their funding structure. So what does it mean if we go more towards that type of assets? I think one thing that we didn't mention and is important to note is that stable coins cannot pay a yield. That has been prohibited by European regulation, that has been prohibited by the Genius Act as well, although there have been some loopholes in the US. So in that sense, they don't necessarily provide direct competitions to the banks. But one thing on the European banking space is that they haven't just sat there, they like providing some defensive strategies. We've seen last month a consortium of 9 European large banks creating their own stable coins under the MICA. Thank you. That's MICA. I was wondering what was the MICA regulation. Some Japanese banks have been doing the same thing, and Fiserv in the US for regional banks as well. So we're seeing more and more movement. But as I said in the intro, it's still nascent, but definitely something that, one, we need to be aware of and continue to educate ourselves as we are doing today, and two, be very aware of potential risk because they are plentiful, most notably for financial stability, as you mentioned, Victoria.
Thanks for highlighting, I mean, the impact on the volatility of bank deposits, and both, I think, Isabel and John's speech talked to the fact that there would be new drivers to reserve demand, and that somehow we need to make our frameworks fit for these drivers, hence keeping the flexibility and the sufficiency of reserves. So, Nicola, you're on the spot for bank deposits and other things.
As I said, innovation is very stimulating. It's still very early stage, very fluid in terms of the use cases. Yes. And I think it's the nature of research, and you are more familiar with research than I am probably, but you don't necessarily, you will find things along the way, and you need to be ready to adapt, and it's very important to take part of all these discussions and to be really within this innovation mind. Having said that, the reaction, I think, shall not be to throw away too quickly a system that is very resilient, a two-tier system, And to name a couple of reasons, the first one would be anti-money laundering and all the financial security that this provides. I think it is very important. The second reason would be what I mentioned earlier about the necessity to transform the deposits into unsecured credits to the economy. It's absolutely fundamental. And a stable coin that would access a central bank would probably become a store of value and sterilize that money. So the impact for the economy eventually should be taken into account. My last comment would be on wholesale CBDC. I think it's very critical. It's very important. We also take part of all the experimentations that the ECB is conducting. And it's very important to build the infrastructure to have a competitive tokenized ecosystem that would be valid for every instrument, including the assets, and be able to pledge those assets as collateral, etc.
Yeah, let me stress that. I think that tokenized forms of central bank money are really a key enabler to the future of financial markets in tokenized forms. It's money markets, it's bond markets, yeah. And clearly at the ECB, we're very committed to provide that as well within a time frame that allows to match the pace of financial innovation we're experiencing. So mission accomplished. But now we turn to the audience, and we have 15 to 20 minutes, depending how long you want to discuss, to take questions. Oh, I knew. Anne-Marie.
Thank you very much. Super panel. I appreciate all your insights. Could I just ask a question to Vicky? And thank you for trailing the DP coming on Monday. So I'm interested in the views, particularly of you and maybe any others who want to comment on having backstops for central banks. I think it's been trailed that the Bank of England is considering access to balance sheet or facilities for stablecoins. And it's just to understand your thinking on the guardrails that you'd put around that. Who would have access? Would it be banks and non-banks? Would you differentiate between different types of stablecoin issuers? Some are issued by banks, some are not. And what circumstances you might see something like that being activated, while appreciating you're in the information discovery phase of a DP, not activating new policies. Thanks.
Yes, no, thanks very much, Anne-Marie, and nice to see you again. We used to work together many years ago. So So in the 2023 sort of vision of systemic stablecoin, there would have been no need for a lender of last resort function, because the coins would have been backed 100% by central bank reserves. For those who have lived in the UK, not dissimilar to what sort of Scottish or Irish notes are. Because the UK is actually 4 countries. But in this version, because we are going to be allowing government some short-term government debt, there is always sort of interest rate risk. So there is always the possibility that the coin is not backed up 100%. So what do you do for that? So under the assumption that, of course, the stablecoin provider is solvent, because of course we don't do lender of last resort to insolvent institutions, then we are considering, and this is going to be in the CP, in the consultation paper on Monday, but it has already been trailed in one of our deputy governor's speeches. We are considering, so my area of the bank is considering a lender of last resort facility given this development. In terms of who can be a stablecoin provider, I mean, it can be a non-bank. Yeah. So this is absolutely clear. In the same time, back in I think 2023, I was still in my previous role. We issued a letter explaining how we perceived tokenized deposits, and tokenized deposits are also. We would encourage banks to develop tokenized deposits, and of course, banks do already benefit from a central bank lender of last resort system, and indeed resolution systems that we may also need to think about in terms of non-bank stablecoins.
Yeah.
Thanks.
So basically, stablecoins and tokenized deposits are not mutually exclusive.
Indeed, and I mean, I'm expecting to see a very sort of dynamic, competitive environment in these developments, which should encourage innovation, but obviously will have implications for the central bank balance sheet, as you were saying, Iman. And if I may add, because I totally agree with the point that you made earlier, I think for wholesale settlement, which is of course the settlement you have for the settlement of transactions in core markets, there being able to do that in central bank money in digital form or not is quite crucial for financial stability.
Mm-hmm. Exactly. Would you like to react? Not at this point, Nicolas.
I can jump in. I think it's risky to discuss when something doesn't yet exist about one specific feature. I think it's very important to think of the objectives of what we are trying to achieve before deciding ex ante that if someone builds something that becomes systemic, be reassured you will have access to this and that. I think, and it's complex, it's fluid, but it's very important to think of the overall system instead of a specific feature separately. That would be my only comment.
Also because Vicky said, like, the systemic character or not of all of this matters for the central bank, obviously.
And matters for the impact on the overall economy, what you're going to do. And by stating something on a specific feature for something that does not yet exist, you are strongly shaping the development of some type of activities, and it will be very difficult if you realize later on that the impact is not what you wanted. You will just be not be able, in fact, to change the course, because it will be very difficult to change that public statement.
And of course, moral hazard potentially as well. Let me take other questions. Yes, please. And then we go to.
Thank you, Iman. Ilya Lingorsky, Bulgarian. Hello?
We can hear you.
Yes.
Thank you, Iman. Ilya Lingorsky, Bulgarian National Bank. A question to Søren maybe, but all the others. Picking on what Søren said about dollar dominance, intentions or views with regard to stablecoins. How do you see the evolution of the euro-dollar market with tokenization, and also perhaps the impact on on American short-term debt issuance, given the fact that through tokenization you may access another few $1 trillion, which are sitting idly or semi-idly globally as liquidity, particularly given the fact that the technology will allow you now at individual level to, offer products which are, creating new demand for US debt.
So maybe on the spillovers, you want Søren to take it?
Yeah, absolutely. I can make a start. So I think you're raising an important issue there in terms of other features or side effects, intended or otherwise, that an expansion of stablecoin may have. So, among the numbers that I quoted earlier, going from 300 billion to 1.5 to 2 trillion over the next 5 years, around $500 billion of that growth, according to these estimates, will be driven by idle non-dollar utility, non-dollar liquidity, as you called it. Right, so this would be sort of the minimum inflow, if you will, that would have to be backed by short-dated liquidity, short-dated assets, high-quality assets. Amongst others, I think according to the Genius Act, treasuries with up to 93 days residual maturity. These estimates also, are for domestic channels, etc. So additional take-up that could increase treasury demand by 1 trillion in a 6 trillion market. That is not insignificant, with a very, very heavy steer towards the short end, as I just said. Now, you would expect that that has implications, or could have implications, for issuance patterns and for the curve. Right? So I think that is something to take seriously and to think about. My perception, but again, this is very much an outsider's perspective, is that is probably a desired feature rather than something that raises concerns.
Yeah. Professor Allen? Yeah.
So one of the important aspects of the whole crypto revolution is that people can sit at their computer and access products anywhere around the world and make investments and so on. And one of the issues about these regulations is how easy they are to get around. So at the moment we have the Genius Act and similar legislation in Europe that you can't pay interest on stable coins. But what that means is that people that actually generate stable coins are making huge amounts of money because they're able to cream off the whole interest. Now, in the long run, that's probably not stable internationally because some jurisdiction will say, okay, well, we'll let you pay 1% or 2%, and we'll still have enough restrictions so that you pretty much guaranteed that you have a payment. And it's this international competition, which I think is key, that you can't actually control outside your jurisdiction what people are paying. And I think that that's the nature of the competition that is now there and which is important. And it used to be difficult to go cross-border and to take money and invest it elsewhere. And the crypto revolution is really about doing it at your desk, at home, or wherever, and doing it 24/7 and having instant settlement. And that's the nature of the competition that standard financial institutions face going forward. And I think, it's interesting whether the numbers you're quoting, Sorana, include that kind of competition or not.
Yeah, and just to add, I mean, these stablecoin issuers, they operate globally, yeah. So basically, they can be incorporated under different regulation in different jurisdictions. I mean, we do have that with Circle between the US and Europe. And then you wonder, what's really backing the stable coin, yeah? Vicky.
Yeah, well, I do agree with Franklin on this point. And to be honest, regulatory fragmentation is a concern in this development. I mean, at the moment, I'm not so concerned about it in the developments at this point in time, T+0, because these stable coins are mainly used to settle transactions in crypto markets, which are not yet systemic. But once they start settling transactions in more systemic core markets, or once they gain such a size that they're systemic, then the issue of regulatory fragmentation really matters. And this is why in the past with banks, we have international standards to prevent what you described, which is a race to somewhere that might not be the optimum point from a sort of social welfare perspective.
So let's go to Alain.
Thank you. To push further the previous questions is that Lubna said that there are similarities, commonalities between the MiCA and Jesus Act, which is true, but also in terms of the nature of the backing and the redemption, there are differences. And then to jump on the previous question, and this is more a question for you, Iman and Victoria, is that there will be spillover from the evolution in one jurisdiction to the other jurisdiction if you have this arbitrage between the nature of the backing and the redemption in one allowed in one jurisdiction and not elsewhere. So don't you think that two issues? Don't you think that first that force everyone to move at the same speed? To adopt the stable coins and to have to limit this arbitrage. And the second question is that, what about the central bank digital currency? Is there still a place?
Okay, so I'm going to separate that in two parts. The first part is what you said about the different backings, and then I'd appreciate to hear from Nicolas Lubna, okay, because this has implication on the money markets, okay, the kind of weights that you have in the backing of the stable coins. And then your second question, I'm going to use my golden card, which is, this is a market panel, so we're going to keep it a market panel. And then I'll also give the floor to Isabelle, which I'm sure will have insights on all the issues we discussed. So, ladies first.
So just precise exactly what you want me to answer, because I'm conscious of time. I want to make it very focused.
No, just to say, so if you want different regulation, mandate, different weights for bank deposits, potentially reserve, central bank reserve deposits, and T-bills, okay? So how is this going to impact, for example, how you transfer money from money market funds potentially to stable coins, yeah? And also it's going to, of course, impact through T-bills the entire construct of the money market.
Yeah, it's a good question, and obviously we're talking theoretically for the moment, but the key thing, I think, it's around the stability of these underlying assets. I think it has to be trusted, and going back to the singleness of money point, you want to make sure that this peg holds.
Doesn't break the back. It reminds you of something.
But in terms of how we're thinking about it longer term, I think at the moment institutionally we're still very much into the use case, so that there won't be like a strong answer or view that we have on the topic at the moment that we can share publicly.
But I would like to start by responding on the people behind their computer willing to do some things all the time. Well, not everybody is willing to do that, but it's possible. It's not necessarily a stable coin. And for many usage, if you effectively digitalize, there is work to be done on tokenizing the infrastructure.
Yeah.
But it is not necessarily, I mean, you can achieve that. And for clients of the real economy, large and small, it is largely achievable. That's the first point. Second, and you touched upon it, on the risk of depeg. For large transactions, it's very clear that you have zero tolerance
to that.
That, and for that you need to develop the CBDC for the wholesale, and it's a collective effort that we are all doing. And then I think, Soren, you reminded the intention of the build-up of the stable coins, and it's very clear that for an individual who starts an issuer and can earn billions, it makes quickly a huge difference. But then what we want to do with that in each jurisdiction, it's extremely complex.
Yeah, Isabelle.
Just a very short question. So stablecoins seem like a money machine
remunerated stablecoins look like a money machine as long as interest rates are positive. So what happens when interest rates are negative?
Provocative question.
Joker. we suffered too much in that environment. No, but I mean, clearly, with positive interest rates, the people who are launching stable coins are probably, because I'm not in their minds, intending to invest the money they earn to build an ecosystem, because it's a race to effectively gain market share and build an ecosystem. But it's very fluid, and the economists maybe.
Well,
I'm not an economist.
The economists would think of, is there possibly an actor that maybe has not unlimited, but pretty deep pockets and loss-bearing capacity?
No.
And is that maybe sort of, no, but is that a substantive externality that warrants having a public version, a CBDC, rather than private? Because there are circumstances and states of the world where the private platforms and rails, whatever you may call them, break down. That doesn't mean, in my mind, that was actually my question, but I understand as a market panel, so I'm not allowed to ask this question of the policymakers in the room. But my question would be, why can't these things coexist? And why do we have such different perceptions of the importance of sovereignty of money here versus other jurisdictions? But I think you've given a good reason why they should coexist.
And maybe we can take advantage of the very international setting, because there are a lot of stable coins in dollar to ask what happens if the US dollar rates are negative.
Okay, so let me see. I think I'm going to stick to the time, because that's super important in this conference, and we've been doing quite well so far. So it's been a fascinating panel. Join me in congratulating the panelists. And now just a few concluding remarks. I'm going to shift here. That's easier. So thank you for all of you, of course, for joining us here. I think that we had a fascinating combination, actually, of insights, starting with Isabel's opening remarks that, as I said yesterday, I think completely set the tone for this discussion, so thanks very much. Then session one provided fresh evidence on the demand and supply of reserves, and also lessons from interventions in corporate debt market. And let me say that I think for the ECB, the intervention on the commercial paper market is a bit of an example, indeed, of how you conduct market function intervention. Session two, repo markets, so basically going into role of the dollars, how also securities losses impact the dynamics, and the evolving role of collateral. Jeremy, where's Jeremy? Keynote yesterday, very stimulating on treasury market function or dysfunction, actually, and how this raises new questions about central bank's lender of last resort, or market maker, I should say, of last resort, or both, yeah. And then session three, the global funding spillovers. I think that was fascinating on how cross-border linkages shape conditions, not only domestically, but also all over jurisdictions. And session four, Petra, really, I think, preparing the stage for my panel. So I have to thank you very, very much, and all the presenters and panelists. And last but not least, I mean, John, thank you very much for making the trip here, being here with us at the ECB. I think that your speech that was combining theory and practice was really perfect for this audience, yeah, which is basically combining
policy insights, analytical insights, and markets. Yeah, and you're the chair of the Markets Committee, our chair. So thanks a lot. Yeah, and a word to my colleagues, first of all, for the poster presentations that I heard extremely positive feedback, and I'm sure you can agree with me on about providing fresh perspectives. And also, I do think that market functioning topics and especially money markets, interaction with regulation, central bank policies, this is a little bit of an under-researched area. So our academics have done a great job for presenting papers and discussing them. But we have the new generation as well in central banks that is now heavily investing into this field. And I'm really very happy about that. And finally, of course, my panelists, thanks a million for the discussion. So I cannot, and we cannot leave this room without thanking all the people behind the scenes that have been tirelessly, I can tell you, for months, preparing this conference, and that have been attentive to every single detail of the conference. So join me in a big round of applause to them. Finally, I cannot resist to tell you you're invited next year, of course. And we very much look forward to seeing you at this point in time. So it's always early November, just before the BIS meetings, and we'll be sending the dates very soon. So now I close the conference, also close the live stream, and I invite all attendees to enjoy lunch at the same location than yesterday.